I have to have some sort of backup.
Yes,
It's like another year. Okay, really interesting. This year is just like
That's it. All right, it's a little bit after 9, so we should start. We have 2 or 3 members who will join us hopefully in a few minutes. Roll call, please.
Governor Michelle Lujan Grisham. Treasurer Eichenberg.
Present.
Commissioner Garcia Richard. Secretary Via Jackson. Peter Frank.
I'm here.
Rita Eidson. There. Jim Jennings.
Here.
Gerald Lavender.
Here.
Lee Rawson. Michael Messina.
Here.
And Tracy Hartsey. Here. We do have one.
Okay. Thank you. Next is the agenda. Any comments? Okay, yeah. We have forgotten in the past, we usually would go around the room and have people in the behind the table introduce themselves. So why don't we start behind Tim? Tell us who you are and why you're here.
Anthony Myers, from Blackstone, represent Director 6.
Thank you.
Alexander Hill from Blackstone, also here for breakfast.
John Bingaman, Chief of Staff, Governor's Office.
Yes.
Blake Amber, State Investment Council.
Amy Rich from Mercer.
Bob McGuire from Carlisle to talk about the International Energy Partners.
Ryan Bunsen from Carlisle, also here for Carlisle.
Dawn Iglesias from the Legislative Finance Committee and the Analyst Desk.
Seth Margus from Townsend Group, the council's real estate and real assets consultant.
Morning, Jack Cove with Townsend Group as well.
Nate Walton with Aries Management, here to talk about our Aries energy opportunities.
Mary Kuhnberger from Aries as well. I'm here with Nate to talk about your Aries energy.
Carol Bennett, SIC.
Clayton Cleek, SIC staff. Paul Chapman, SIC. Richard Pugmire, Mercer.
Chris Cassidy, SSC.
Brian Conway, Chairman and Managing Partner of TA Associates, here to talk about select opportunities fund. David Lee, SIC staff.
Bart Stuckey, SIC staff.
Tola Wagner, SIC staff.
We have myself, SIC as well.
And Lee. And the commissioner, yes. Leonard, we're almost full. We waited for you.
Thank you.
Okay, so are there any comments on the agenda and suggestions? Otherwise, I'll take a motion to.
Motion to approve agenda.
Thank you, Linda. Second, Michael, thank you. All in favor? Aye. No opposed, so we'll move on. Minutes of the prior meeting in September.
Motion to approve. Second.
Any comments, questions? All in favor? Any opposed? No. It's approved. We go to the State Investment Officer's report, and those items that Steve will talk to us about. Please.
Thanks, Peter. Good morning, everyone. Total distributions from the funds over the past 12 months have been $981,945,000. Our net asset value as of this morning is showing a new intra-month high of $26,549 million. West Texas Intermediate, as of its close yesterday, was at $53.39. And Dawn, I believe the state is budgeting for the FY20 year at $52. Yeah. Those are just items that we track and we think are worth mentioning each month for those of you who have been with us before. Next month, we will be focusing, among other things, on how the Severance Tax Permanent Fund invests in New Mexico businesses. We'll be bringing forth the working group recommendations regarding those investments. And investment staff will also be bringing a structure study regarding New Mexico investments. So it will be an interesting meeting in November. Each of you has at your place a draft of an op-ed regarding the permanent fund's value to the state and the proposed creation of a new fund for early childhood. If any of you are interested in signing this in order to have it published in the print media, please advise Charlie either during the meeting or at the end of the meeting today. This is a topic that was initially introduced, Olivia, I think, by you at the LFC meeting that we had in Red River, as I recall. Is that right? Yeah. Looking at item C on the report that I provided to you this morning, you'll see the two committee meetings that we'll be having in November, as well as the council meeting. You have, I believe, the 2020 calendar, or will have it.
It's included in the materials, and I do have hard copies if anyone prefers it in that.
So please see Carrie if you'd like a hard copy of the 2020 council and committee calendar. We're going to be talking again about strategic planning as we move toward the end of the calendar year. Those of you who have been on the council for a while, bless you. Those of you who have been here for a while know that we did have a strategic plan which comes to an end in December this year. And we'll be asking the council whether you would like to have a new plan for another 3 or 5 years. So stand by for that. In terms of operations, we're still looking for a couple of analysts, a financial analyst as well as an analyst in the communications, legislative and client relations area. Each of you also has at your place a revised one-page supplement to our 60th anniversary report. We're saving money by not publishing another large document this year, but we will be doing something more complete in 2020. We have 4 upcoming interim legislative hearings. LFC budget hearing on October 30th, Economic and Rural Development Committee meeting on November 12th, Revenue Stabilization and Tax Policy Committee on October 24th. There will be a bill discussed at that hearing, which will propose taking an additional 1% from the Severance Tax Permanent Fund for renewable energy.
1%.
An additional 1%.
That's a 20% increase, is that right? Is my math correct?
I don't know, Peter, you're the mathematician.
I think instead of saying 1%, which sounds small, it's important to point out that that is a 20% increase. We give, what, 5% on each year?
No, this is 100%. We haven't done anything for renewable energy.
This is an additional 1%, required 1% from the Severance Tax Permanent Fund for renewable energy.
Right.
So as you recall,
We
just took an additional 1% of the funds for the SBIC, which is now 2%.
So our spending policy on this severance tax fund is 4.7%.
That's our target return.
That's our spending.
Distribution.
That's our distribution is
Their
4.7.
spending policy.
And so this would raise it to 5.7?
No,
Oh, okay.
this is taking an additional 1% of the fund
Oh,
each year. Charlie, how is it worded? It's not each year.
Mr. Chairman, it's just an additional 1%, but it's not an option. It will be a shall rather than a may. And so it would be, think of it as going with the 5% or the 9% for New Mexico private equity and the 2% for SBIC.
Then we have investments and pensions oversight committee on November 18th. The Water Trust Board and the New Mexico Finance Authority, or that board.
Sorry. I usually turn that off, I'm sorry. My true allegiance just came through.
Is that a Loboso?
No, I'm afraid that was Chicago Bears, I'm sorry. My mistake, sorry about that. Introduce a little levity.
There's an interest in improving the sustainability of the Water Trust Fund. And we've been asked by the Finance Authority and the Water Trust Board to work with RBK to provide them with the data necessary for them to determine whether or not they want to pursue a method for improving the sustainability of that Water Trust Fund. Mr. Chairman, that concludes my report.
Okay, thank you.
Yeah, well, thanks, Mr. Chairman. I'll be rather brief, and we'll turn over to our RBK for your performance report. The International Monetary Fund does a big report called their World Economic Outlook twice a year. It's on October again in April. There's a couple of companion pieces with it. The fiscal stability support report is probably the biggest. All total, it's a really good overview of what's happening out in the global economy. We read it closely when it comes out as part of our methodology for sort of knowing what's going on out the world. So I want to give you some of the highlights out of that report, and then we can move to your performance. It's a little bit of a downer, I'll tell you that, because we've already been talking about those things. And Harold, if you want to turn your ringer back on, we can do some levity. So as we've been talking, the global economy is in a synchronized slowdown. We're going to get pretty close to 3%, down pretty close to 3% globally. Positive, down from normal rates, right? For 2019, the IMF is seeing a little bit better in 2020, but significant risks to that forecast. As we've been talking, we think that'll be disappointed. We'll be close or potentially in recession here in the U.S. Japan and Germany are in recession. The Euro area is very close to recession. We've been dropping here in the U.S. Slightly below our long-term potential with a downward trend here in the U.S. We've talked about this over the past few months with you. It's important to note that this has been happening in the face of very strong monetary stimulus and coordinated monetary stimulus from the major central banks. The IMF estimates that added about half a percentage point to that 3% growth. So we would have been at they expect we would have been at 2.5% worldwide had not the monetary policy have been so loose of the major central banks. The 3% that we'll have in 2019 and the 3.1 or so that the IMF is forecasting for 2020 is the lowest growth that we've had since 2008, 2009. Now, again, we've been talking about these things, certainly your position, and how good position, we started positioning in early 2018 when we felt like we were moving into the late cycle. So none of this is unexpected and certainly we're positioned for it. But this is the stats that are coming in as of now. US, China, Euro area, and Japan make up about 50% of the we've talked about that a little bit. That's not really what's pulling growth down though. It's a lot of the emerging markets. So the emerging markets are really slowing out there. That's what's pulling growth down. The growth rates of US, China, Euro, and the Euro area, and Japan have been fairly steady over the last year to 18 months, declining, particularly a little bit in China, but certainly relative to emerging markets, it's been more steady in those four countries, which are most or half of the world out there. Let's see. So overall, at the IMF, regards to the global economy is what they call precarious, with really no real monetary or fiscal mistakes. So we've got our eye close on what governments are doing in terms of central banks doing in terms of monetary policy and what governments are planning in terms of fiscal policy. The Global Financial Stability Report, I mentioned that to you. The main highlights out of that are that they expect interest rates to remain low for long. That's a pretty standard refrain among global economy watchers. And there's a significant risk of financial vulnerability, and those risks are growing. So we're sitting in a pretty unstable spot here, it looks like, certainly with the downward trajectory this year. Looks like the IMF thinks things might bottom out here this quarter, next quarter, and head a little higher for 2020. But they see significant risk to that. We think that's likely to be disappointed or a little bit lower on our estimates and forecasts. But again, we've really shifted out of equities. We're down to 40% publicly traded equity. Most of the funds that I've observed do a good job in the past that have strong CIOs or strong fund structures, they're in about the 35 to 45% range on public equity. So we're right in the middle of that. Also, folks have been selling core bonds. As you know, they're down to 10% in the core bond portfolio, and about a third of that is in short duration. So we're not taking much duration risk. If the rates do bounce up against us, and we're not exposed so much to that duration to earn similar income as to what we can through our shorter duration bonds. We've really pushed the money out into things that generate income and have generally more stable asset values, and try to keep some growth in the portfolio through keeping your private equity portfolio up around that 11 to 12% range, 7%. So I know it's a little bit of a bummer of an outlook. We do expect things though to improve 21, 22, and we'll start actually getting some of the demographic things that have been weighing on us now for the last 6 or 7 years, starting to roll off about 2025, 2026. So we'll start improving a little bit out into that time frame. So the rest of the baby boomers will be retiring sometime in that time frame, and the millennial group is a pretty good sized group, and they're moving into the workforce pretty quick, pretty fast pace. So more out into the mid next decade, things start improving fundamentally from a demographic position. But from that until then, things might be a little bit rocky, and certainly we're just trying to be in position for that. And that's my report, Mr. Chairman.
Thank you. Okay, I guess we should move into the performance reports with Marcia. Yes.
So we'll go to page 17, and this is the August flash, and I will be pretty brief on here. Just as a reminder, since lots have happened, saw negative equity returns. The S&P was down over 1.5%, 1.58. Developed non-US was down almost 2.6, and emerging markets was down almost 5%, 4.88. So we saw negative equity numbers. On the other hand, we saw a positive US bond performance. The ag was up 2.59 just for the month, And we'll talk about, just briefly about that, because as Vince pointed out, your portfolio was a little shorter in duration, so it did not do as well for the month of August. If we look down below, you can see the total fund for the month, you were down 0.56, for the quarter down 0.42, and then the land grant number was down 0.64 for August, severance a little better, down 0.55. But looking at calendar years look strong. Land grant was up 8.6, still trailing the benchmark, and the severance was up 8.34, also trailing the benchmark as of August. And I'll give you a little spoiler alert for September. Page 18, we want to go over page 18 because your investment committee chair had a question about this page at the CIC meeting. If you, this is where we look at all the funds, and first of all, I'll point out that you will now see the tax stabilization listed here, and you'll also see the rural libraries total fund listed here, although you haven't, we'll be talking about the asset allocation for rural libraries a little bit later today, but the money was deposited, so that's reflected. But if you go over and you look at the returns for this period, you can see a number that stands out, and that was for the tobacco fund. The tobacco fund, your chairman said, can that really be right, up calendar year to date over 15%? And we checked the numbers twice, 3 times, 4 times. And the fact is, you might recall that you changed the allocation for the tobacco fund. You made it more conservative. And sometimes timing works out. Sometimes it doesn't. But you went from a equity, both U.S. and international combined allocation of 65, a target of 65% equities in the tobacco fund. And you had that in June. And then you changed your allocation to a more modest equity allocation to 10% U.S., 10% non-U.S. Perfect timing, again, because you had very strong returns for U.S. markets over 16%, for non-U.S. markets 13%, and then you sold out of the equities, so you captured your gains and went into more conservative investments. So timing does work sometimes in your favor, and it did for the tobacco fund. So if you have any questions about that, we just wanted to share that with you, because we thought you probably would notice it, like your chair of the investment committee. On page 19, I'll just make a couple comments about this page. Again, you can see your total fund performance for the month for the land grant and severance. Looking at the composites for the asset classes, global equity, U.S. equity composite, and the non-U.S. equity composite both outperformed for the month, and on your fiscal year to date have outperformed as well. So nice outperformance from your equity portfolio. Where you had a headwind in August, as I mentioned earlier, and as Vince pointed out, you have a shorter duration in your core fixed income composite, and that was a headwind for you in August, and you can see you trailed your benchmark for both the core portfolio and the non-core portfolio. In the non-core portfolio, we've mentioned this before, there is not a perfect benchmark for the non-core portfolio where you've been lagging that benchmark a month. So, yes, so you can see underperformance for both of those composites. The remainder on the following page are your specialty consultants are going to update you on second quarter performance. You can see in August, since that's not a quarter end, we show that performance is 0. But unfortunately, the publicly traded asset that you do have in real return is the MLP portfolio, and it had a bad month. Again, down 4.89 just for the month of August. Now on the spoiler alert, September was a good month for you. We believe you'll have outperformance both from your land grant and the severance tax, your composites. We believe when we get final numbers, then you'll see that your composites did much better for the month of September, and that will continue on through the calendar year to date and fiscal year to date. Preliminary number, we don't have it broken for land grant, and severance was in the month of September. And then again, this is preliminary, without the private assets in there, but you were up for the month, about 1.3%. And we also, interesting, what you'll see in September, as we have talked, and Vince has mentioned how the difference on the equity side between value stocks and growth stocks has been significant. Growth has been outperforming for quite some time. We saw a shift in September, the value significantly outperformed growth, and non-US did much better as well in the month of September. Thank you.
Okay, thank you. Oh, sure, yeah, I'm sorry. Any questions or comments? Yes, sure.
Thank you, Mr. Chair. Marcia, would you, your page 8, our page 23, has more with the manager's skill and the jobs that we have there.
That's for the one year number. And you did, again, this is telling the story that most of your return comes from your asset allocation decision. And that's the blue line. So you had your asset allocation decisions provide most of the performance, but you did have manager skill that was negative for that 1 year period, driven mostly by private equity. And again, that's a bench, we've talked about benchmarking in private equity. It's very difficult to do. Also, we had negative performance on real return. You're still building out the private side of that portfolio. And I just mentioned how MLPs are your only publicly traded there. And it's been difficult for MLPs and managers and MLPs. And then you can also see the ECI also contributed negative for the year. The preliminary numbers we're seeing, at least on the publicly traded portfolio, we're seeing that you'll see improvement in that manager skill when we look at the third quarter, calendar quarter report.
Thank you, Mr. Chair.
Okay, thank you. Yes, Michael.
What does that mean? What is manager's skill measured about?
That's just how you manage that column is just how your managers did against their benchmark.
Any other questions? Okay, we all get very used to this, but I'm realizing some of you are new, and these are kind of unusual metrics that
I'm happy that Matthias and I would be more than happy to meet with you individually and go over these reports in more detail.
Yes, Linda.
I also want to mention that you get quarterly reports like we're going to receive right now for each of these private asset classes. So if you're wondering about manager skill in these private asset classes, the quarterly performance will give you some clue as to what's happening there.
Mr. Chair, Marcia, can you go to your page 20, page 35? It has to do with your MLPs. I just put a note here to ask you what you think the outlook is for MLPs in the future.
Would you like me to take that? Yeah, so actually you're going to hear about some really talented people in the MLP space today. So, but we believe that it's a very promising area still. It's had a hard time. We think that the value that's there is not really being recognized by the public market, and that's part of the larger story about capital that's kind of running away from certain types of energy investments. But we think the fundamentals are very good there, and we think it's a position we want to hold.
Paul, what is your income? How much income are you getting out of that work?
Well, AMLP, the publicly traded stock, throws off like, I didn't check today, but an 8.5 dividend. So I would expect after fees that we're in the high 7s someplace.
That's right, it's about 7.5% on an annual basis.
Okay. All this real estate.
We say real return.
Right.
Thank you, Chairman Frank and members. Good morning. We're going to talk about performance for the second quarter of 2019, and Seth will cover that. As we get into real estate, we're pleased with the performance there. We're outperforming in all timeframes. And you read a lot in the newspapers, I do, about what's going on in the retail world. And the fact that we're light on retail, intentionally light on retail, is why that's one contributing factor to our strong returns. We are intentionally heavy on industrial because that's picking up the slack from what's going on in the retail space. So we're long in industrial, and that's good for us. So those are the two things that are really driving our positive performance.
Great, thanks, Paul. So this is, again, second quarter performance. First, I just want to talk a little bit about the allocation. So we have a 12% allocation to real estate. We've been sort of chasing that number for a long time now because of the success of the total plan that Steve and Vincent have described. So this quarter, particularly, we jumped about 140 basis points in allocation because of our rebalancing of the equity portfolio into real estate. So $300 million was called as of June 30th. That increased our real estate allocation to 10.8%. So about 140 basis points of an increase quarter over quarter. As you recall, in the last couple of quarters, and I'm on slide 5, I apologize for in the town presentation, slide 5. You can see the commitments dating back to inception, and you'll see 2019 being one of our more active vintage years. There's a couple of investments that are not tracked on here yet since they're subsequent to quarter end. But this will be our most active vintage year. You'll see the dark blue lines being the non-core commitments, so the closed end 3 to 5 year investment period that capital is called over time and then returned to you as assets are sold. The light blue are core open-ended fund commitments. Those are perpetual life vehicles. The capital is called like the $300 million I just described, and it's out there in perpetuity unless we choose to rebalance it, and we have done that in some cases. There were 2 additional commitments made in the third quarter. One part of the tax stabilization fund at $125 million that was allocated to real estate. Another $100 million was also committed part of the rebalancing, a couple of redemptions from some of the core managers that have been underperforming or have a higher allocation of retail, as Paul mentioned. So that number will continue to jump in pretty significant numbers or amounts as that capital is called usually all at once. So those 2 commitments alone are another $225 million that we called relatively quickly, and they get move our allocation probably by year end very close to that 11-12%.
Just calibrating it. So the tax stabilization fund took a piece of the real estate pool. Is that what happened?
So yes, but there's a new commitment that we also made to the Clarion.
Yes, but they're only getting a piece of that. They're getting
a piece of the overall real estate.
Right, okay, all right.
So that's on the allocation. The other point I wanted to make this quarter, and I have talked about backing up just one slide to slide 4, is the outperformance. So showing on slide 4 is both the total portfolio, the first bar, the new commitments made since the rebalance in 2011, and then the Odyssey, the index of the real estate portfolios. You see the consistent outperformance. We show the quarter 1, 3, 5, 7 years here, and as well as the since inception that IRR. Again, that outperformance, as Paul mentioned, is driven by our industrial exposure, as well as some of our realizations from the non-core commitments made during those earlier vintage years that I described. So back in 2011 to 12, those funds are being fully realized today and selling into an attractive market, and we're seeing attractive returns out of them. If you think back, I look back obviously from quarter to quarter. In the second quarter, in the first quarter, we also outperformed by 20 to 30 basis points. But 2018, we were actually negative for about 3 to 4 quarters in a row. We were underperforming the index. Obviously, that is reversed. The volatility there is not uncommon. Core performance has remained volatile. I think the retail sector, for one, is creating some of that volatility. Currency fluctuations in our international investments is another. And the third being the debt market. The mark-to-market as the interest rates change. So those will remain somewhat volatile, but obviously strong outperformance here, and right in the range of our sort of 5 to 7%, target return on an annual basis. The other primary slide we've shown is the fee savings, which we always like to highlight, but it continues to grow as we make these commitments to strong managers, but also able to drive reduction in fees through aggregation of commitments. Slide 6 highlights all of the investments today where we do show fee savings. There will be more of these based on recent commitments to Exeter and other funds that we've been through subsequent to second quarter end. But if you look at this chart here, we're saving about approximately $2.5 million on an annual basis, so year in, year out, through negotiating with fee savings.
And those are towns fee savings, so we get volume discounts on top of that.
Correct. And the rest of this presentation you've seen before, we do highlight some significant events. We also continue to include a summary of the legacy positions in the portfolio. Those are moving towards liquidation, slower than we have all wanted to, but over the next handful of years, those will be liquidated. Those are on slides 15 and 16 if there's any questions. But I'll stop here and open up any questions.
All right, are there any questions? This is a real success story for the council. You guys should be very proud of all of those being real accomplished.
Yeah, we're pleased. I wish we could carry that same momentum into the next section, which is real return, but we're working on it.
Right. Okay, we move to real return then? Thank you.
Yeah.
Great.
Yeah, go ahead.
Okay. So I'll start again. So this one is a little different than you've seen in the past. So we talked about the NLPs a couple times already this morning. Historically, this presentation only included the real return or the real assets of the real return portfolio. So that excluded the financial assets, which is primarily MLPs. About 97% of the financial assets today is MLPs. The remaining 3% is real estate debt commitments that are actively being called and being invested. But on slide 4 and 5, we show the financial assets as well, or the real assets as well as the financial assets allocation for the portfolio. And on slide 5, we show the total return of those two portfolios. So the total real return portfolio allocation is 12%. We're at a funded allocation today of 8.4% versus our 12% target. And the real assets portion of that is about 9.5%. So we're, and there's a lot of percentages going out there, I apologize, but the 9.5%, we're about 6.5% towards that target. So we've got some room to make commitments, and we'll hear about 3 of them, or 2 of them today. You'll see on slide 5 the volatility of the returns when MLPs are introduced. So the first column in this chart includes the total real return portfolio, so all of the real assets, the energy, the infrastructure, timber, and ag that you've seen in the past, as well as the MLPs. The MLPs over the 1-year period reduced the return from to 2.8% versus a 3.4% just on the private side. And so on and so forth, the 5-year obviously being the most significant impact on the total return of the portfolio. So we talked about the volatility there. If we move ahead to the slide 7 and forward, these are the slides that you've historically seen in our presentation, focusing exclusively on the private asset class, the real assets portion of that portfolio. Historical commitments, again, are shown on slide 8, similar to what we showed in real estate. You'll see we've made pretty consistent commitments over the last 8 years. 2019, again, will be a more active year after, depending on how the votes go today. But based on the opportunity set, there's a lot of good opportunities today. And part of the plan for today is also to reduce some of that MLP exposure through new commitments. So trade somewhat of public market exposure to some of the private market assets. So that's sort of what's driving some of the 2019 commitments that you'll hear about. Additionally, when I was here presenting the first quarter performance, I mentioned a potential new infrastructure commitment later on this year. That one has been delayed a little bit on their side, not on our side, but on the fundraising side. So that'll be a January, February first quarter event for new.
Is that an international or a U.S. based infrastructure?
There's an international one that we're looking at, a European-based one that we're looking at right now. But there's, we have a significant pipeline of other things that are.
The next slide, and maybe the last slide I'll really talk about, is slide 9, showing the total portfolio performance. And this is, again, just the real assets portfolio. So I should correct that. Total the real assets portfolio performance. You'll see the annual return here of 6.8% versus the target of 7.5%. So slightly lagging the target return. And what's driving that reduction or that underperformance is some of the energy exposure within the portfolio. So I've said this in the past, and I just think it's important to sort of point out how volatile that energy portfolio can be. So in 2018, calendar year 2018, the energy portfolio delivered 4.5%, pretty low, but okay. In 2017 and 16, it delivered at 18% and then 27%. So very significant, strong returns. Prior to that, 14 and 15, it was a -9 and a -6. So you see the volatility that happens within the energy sector. That is moving these numbers, that is impacting your return. On slide 10, we like to look at it more over a long return, the 3-year return for the real assets portfolio is 7.7%. 3 years out of energy is a 14, 3 years out of infrastructure is an 11. So that's really driving that 3-year return for the real return portfolio. The rest of these materials you've seen in the past, but happy to answer any questions.
Yes, Linda, please.
I just want to point out, especially for the new members, one of the pages that's my favorite page in the Townsend report. It's our page 91, and they have this in the real estate also. And this is what really is helping to fulfill our fiduciary obligation by giving us a checklist of the things that we ought to be looking at. So that we are looking at this asset class, saying, yes, it meets the criteria that we have established for this asset class. And I think that's a very important page.
Yeah, not to belabor the point necessarily, but my view, and I've been here 10 years, my view is that the detail that we receive from you all is extensive, is really what I expect Paul and Vince and his team to be reviewing in depth and staying on top of. I believe our job is to ensure that that kind of reporting goes to CED, and that we look at what Linda pointed out, are you in line with the policy? Because for me, for example, to pick out a line item on a particular investment question at this point, it's kind of a worthless undertaking. It's the policy and the decisions we make in allocation here. So we spend a lot of time with 500 or 600 pages, most of which I'm assuming Paul and Vince and your team are assessing and absorbing regularly, and our job is to make sure that's happening. Our job is not, I don't believe, to question each and every number on each and every report. That's not our capability. And I think that does a great job. The investment committee getting into it, we oversee it. And so we will be looking at, and Linda hopefully will be bringing some recommendations on how we might reduce the volume of paper that we look at every month. Because, again, as I said, my philosophy, you all can agree or not agree if we move forward. I explain, so we'll see what you can bring forward to us as some recommendations. Any comments? All right. Our next item on the agenda is Linda's report. Thank you, Paul.
You got it.
Well, this voluminous material that we have had this month and last month has led me to exactly what Peter talked about. We're looking at ways to streamline this to be material that is just necessary for us to review and what our function is. During the meeting, we discussed a number of things. These managers are mostly managers who you already know. So they are not re-ups. A re-up is when it's a series. So you might have a fund that is nearing the end of its lifetime and you want to replace that fund with another like fund. That's a re-up. These are not re-ups. These are new funds with existing managers. So they're managers who we've already looked at. One fund has a slightly different strategy and a slightly different fee structure than we've had previously. And we had some discussion on this until we determined that we liked it very, very much. And we decided that all of the funds that are presented today do meet our policy. They do meet our asset allocation. They do meet our pacing. They do meet the fees that are appropriate for that asset class, and we unanimously approve them. We also have a fairly lengthy discussion on an investment policy. There are some changes being made in that were a result of our meeting, and that will be presented to the council at a later date.
Okay, thank you. So our first.
Mr. Chairman, can I ask a question? And I don't know if this will go to the actual vote discussion, but on one of the investments, on the Aries investment, it says here the commitment will be funded through partial redemptions from the MLP portfolio. Is that what we'll draw down?
Yeah, well, yeah, I think I was just gonna say, Paul will talk about that. We discussed that also, and that's when we had a fairly lengthy discussion regarding MLPs at the investment committee, and noticed it, but that was part of the source of the funds, and they'll discuss it when they present that. But that's a good,
No, it's a
good
good
observation.
question, because it is kind of a pregnant comment.
Yeah.
And raises a lot of issues, so we'll see, but Paul can describe those later on. So we'll get to that, but why don't we start with TA? Well, thank you for joining us tonight. We look familiar. You've been here several times, I think. I guess, David, why don't you take the lead?
Thank you, Mr. Chairman. We're here today to talk about TA, Select Opportunities Fund. We have the usual suspects here, myself, David Lee, Private Equity Director, and Richard Piltmeyer of Mercer Associates. And our guest today is Brian Conway, Chairman and Co-Managing Partner of TA Associates. These materials start on diligent page 117. As a reminder, the reason why people look familiar, if you recall in February's meeting, we brought TA 13 for $100 million. So, but this is a separate fund series. As a reminder, TA has a growth and buyout strategy which is focused on middle market and upper middle market. Select Opportunities is a best ideas fund that will invest in high-performing current TA portfolio companies. By high-performing, we mean it has a minimum hurdle of 2.5 times. This fund would invest alongside an independent third-party financial sponsor. In other words, another fund who would be the lead investor, would set the terms, etc. The portfolio will have 10 to 15 minority investments, recapitalizations with a check size of between $50 and $100 million. The target sectors for TA are technology, financial services, business services, healthcare, and consumer. But the focus of this fund would be on high quality business models with a lot of recurring revenue, high margins, and the emphasis there would be more on software and payment processing companies historically. This fund is targeting $750 million with a hard cap of $1 billion. So it's significantly smaller than the main fund, TA 13 that we brought in February at an $8.5 billion hard cap, and Fund 12 had a $5.3 billion hard cap. The GP commitment, we always like to see this, will be at least 12% for this fund. Because these are current holdings, TA will benefit from effectively asymmetric knowledge of these companies and their markets, which we think leads to an attractive risk reward. The fund terms and economics actually reflect this approach. There is a 20% carry, but there's no management fee. So we are very appreciative of the strong alignment set up by the fund terms. The return targets for this fund are the same as the flagship funds. They continue to seek top quartile performance. As a result, staff and consultant recommend commitments of up to $75 million to TA Select Opportunities Fund. With that, I'll go ahead and turn it over to Brian Conway.
Thanks, David. So again, I'm Brian Conway. I'm chair and co-managing partner of TA Associates. I've been at the firm 35 years, and in my current role, just over 5 years. Prior to that, I was co-head of our techs about half of what we do. So first off, thanks very much for your support. As David said, you just committed to our most recent growth private equity fund, Fund 13, and you were also investors in prior funds, including TA 12. So I'm here to talk about TA Select Opportunities Fund, but I thought I'd give you a quick refresher on who we are. TA is 51 years old, celebrated our 50th anniversary last year. We're a leader in growth private equity. We're a sole strategy fund. We are not a multi-product fund. We focus on growth private equity exclusively. We have a good long-term record. We outperform private equity and the public markets over 1, 3, 5, 10, 20 years, delivering just under 20% net to our investors over 20 years. And actually that's increasing. We were up 41% last year, and your fund TA12 was up 26% for the first 6 months, and I think it'll be up again in the third quarter. And we should be, I think we've gotten back about 40 cents on the dollar in that 2016 fund to you in terms of distributions. And I listened earlier when you talked about distributions. I think it was 3.5–4% on assets, and our goal is to do better than 30%. That's what we've done the last 10 years, 31% distribution yield back to our investors. So our strategy for growth private equity is to focus on growth and quality. By growth, we mean the last 5 years, median growth rate of new investments was 30%, and that's the number 1, 2, and 3 driver of our performance at sustained earnings growth. And then since the downturn, when we made some mistakes in our 06 fund, we focused on high quality business models, as David mentioned. About 80% of the portfolio now are recurring or highly repeating business models. So it's growth and quality, deep industry expertise. We've been investors in the software industry since 1979. For example, my first investments in software were mainframe software, which shows my age. So we have 5 industry groups, but as David said, this will be a concentrated fund. This is a best ideas fund. So the companies that exhibit, they're proven winners in the portfolio, and they have high quality business models tend to be concentrated in businesses like software businesses, data businesses, payments type businesses. Third leg of the stool or table is we're known for this, we originate proprietary opportunities. So last year we contacted 15,000 companies, partners and 2,400 companies, we made 16 investments. So at our 50th anniversary, we gave everybody not on the investment staff 2 free round trip tickets. That's sort of a commemoration of the 50th anniversary. We didn't have to pay anything because we had so many miles built up around visiting company. And then we try to drive that growth through what we call growth value add. So it's different than traditional private equity firm because it's focused on growth. At breakfast, David asked, you might get asked why select opportunities, why are you doing this? So I thought I'd just address that up front. So, as I said, we made mistakes and we underperformed in our 06 fund in the downturn. So we redoubled or increased our focus on these sustainable earnings and high quality business models and have taken that up to 80% of the portfolio. And then everybody always talks about their investment strategy and nobody talks about their liquidity strategy. We are very, very intentional and deliberate about getting liquidity to manage risk so that distribution yield of 31% didn't happen by accident. So and I get a lot of grief from my partners who are selling pieces of our best companies. So there's some partners from Carlisle here. We have a company, Discover Board, that's earnings through September of 42%. And we sold about a third of the company to Carlisle in an equity recap, and that was to take money off the table. So we have roughly 10 times our money. I think we took 4.5 out, rolled 5.5. I may have that reversed, but that's an intentional strategy. There's been about $8 billion just as recently invested by other high quality GPs like Carlisle in our portfolio because of this proprietary origination. About 80% of what we do, we reach out to a company, create a relationship, and create an opportunity to invest. So we have what the rest of the private equity business wants, which are high quality growth companies. So we said we'd only give up this risk reward strategy of intentional liquidity, but we see billions of dollars being invested by other people's LPs into these companies, so why not, how about for our LPs? So think of it, if we end up at $1 billion fund and history repeats and there's, like there having since 2017, about $8 billion invested in our funds, and that we would just take one out of the 8 and the third party GP would price that opportunity. So David did a great job summarizing. Select Ops is a best ideas fund in proven high performing companies. We have a concentrated portfolio of 10 or 15 companies. Out of our portfolio right now is about 83 companies. So one of the things why you may not have heard of this kind of idea before is not many private equity firms have portfolios as large as ours. And sort of a sidebar, but the reason for that is even though we have an $8.5 billion fund, we're focused on lower and middle market companies, smaller companies. So our median enterprise value is sort of 300 million, something like that. So as David said, I stole that phrase asymmetric information from one of our investors. I thought it sounded really fancy. But it's true. We know these companies better than the third parties coming in. We're certainly better than the LPs who are coming in sometimes to co-investments with those third party GPs. They would call us to do their due diligence, so we're scratching our heads saying, this is our company, we know it better, they're calling us to do due diligence, so that GP is getting the credit for bringing co-investment to someone else. So we know the company's better than anyone else. I think that'll improve our selection, and it should reduce any capital risk of capital loss. We've addressed the potential conflict. Number one question from our investors when we started to hatch this idea was, well, what about the conflict of interest? Other GPs will do cross-fund deals. So we said, all right, we will make it that this will only invest when a high-quality third-party GP invests. It will invest in everyone. It will be select opportunities out of those groups. So there'll be a high-quality GP pricing it, and we'll be a minority investor in that transaction so that we can take off the table the risk of we're both a buyer and a seller, and we're determining what the quote-unquote fair price is. And then as David said, since it's a new fund in existing companies, we had started with 1% of invested capital and decided with feedback, and to be frank, I don't think we needed to do this, but we just thought, let's keep it simple. Let's have a 20% carry. Let's increase our co-investment from 8 to 12% and reduce the fee to 0. So the other GPs in the room are probably not happy to hear that.
It's a new model for us.
Hopefully it's not a sustained model for the industry. We thought it was appropriate for this one. So that's all I have to say. I had 25 slides, and presuming that you had a chance to see those, you just saw TA13 and I know the firm pretty well. But happy to take any questions if you want.
So this is clearly a new model for us. We don't have any other funds like this. Has anybody else done this in the industry that you're aware of?
I don't think there's anything quite like this. There's a trend toward longer holds, or some of the longer hold funds. So for that company that we spent so much effort originating, the TA funds will have a longer hold, but the flagship fund might still have its 5 or 6 year hold period. That doesn't mean that Select Ops can't continue to participate in the growth of that company. We will continue to be on the board and using our strategic resources group to add value. So it will be somewhat similar to this approach of taking your best companies and hoping just forever companies. It's somewhat related to these co-investment funds that people have done because they're investments. But I think it's better than that because co-investment is a brand new idea, and you're both doing due diligence side by side or piggybacking on the GP's due diligence. This company we've known for 1, 2, 3 years, been on the board, been fundamental to the value creation strategy. So we were talking at breakfast, I'm only aware of a couple of other firms that have portfolios as large as we do, that might,
Be interested in this.
might be interested in this kind of thing. I don't know if that answers the question.
No, thank you.
Questions from the rest of the council? Anybody have any questions?
No question.
Ryan, that fly all the way out here, doesn't need to get checked.
I'm looking out the window.
Makes it worth it.
Well, we're,
Based on the recommendation of the Council Investment Committee, Private Equity Advisor Mercer, SIC staff, and the General Fiduciary Oversight of RBK, I move that the SIC approve a commitment of up to $75 million to TA Select Opportunities Fund A LP, subject to and contingent upon New Mexico state laws, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
All right, thank you. Tim?
I know you're gonna ask me this, Mr. Chairman, because I'm not gonna vote in favor of this particular investment. But I thought I would just ask my question, and I guess it's more of David, because I see this more in the secondary market. And I see this State Investment Council investing in itself in the secondary market. And isn't that incredibly prone to conflict of interest? I mean, you pointed out in here a couple of times, but why are we chasing our own tail?
First of all, I think probably the most important consideration here is what we're trying to do, staff and consultant for the portfolio, is we're trying to increase our exposure to higher quality managers, because we feel like those managers are the ones that are going to invest in the better companies and provide the returns for the council. In terms of conflicts of interest, there is potential for a lot of different places, and that's one of the places where consultant staff spend a lot of time going through, and actually we had conversations with TA, their other potential LPs had lots of conversations with TA, asking, how are you addressing this? How are you addressing that? And that's how we got comfortable. There's different ways that you can address the situation of, we invested in a company, we improved it, and now we're either going to sell it or we're going to continue the ownership. The trend in the industry is to take those winners and want to hold on to them for longer. We feel like this vehicle, which, as Brian said, combines some aspects of co-investment, some aspects of long-dated, we feel like it's the best vehicle as opposed to some of the other options. Some of the other options would be, if there's a company in TA12 that has done well, but they don't want to give up the ownership of it because they like the company and they're comfortable and they think there's still a lot of room to run, they could sell it to TA14 when we bring that in. Or they could just sell out of the whole thing. And if you sell out of TA12 versus TA14, which this happens a lot with our other GPs, then you don't get the benefit of getting effectively an elimination of the J curve because we're not paying attention on this. Starting that clock from the beginning, 1.5%, 1.75%, 2% of commitment fee, followed by
Without the fee, then we're still at a target.
Sorry,
We're still not showing a target
I'm sorry, a target for.
for our return. We're giving our 20%.
There is no
So I mean, you're talking about, yes, they reduced fees, but they're also not giving us a target.
There is a return target. 25 to 30% gross IRR, 3 times invested capital.
Those are the targets that they see.
And that's one of the things we like about this strategy. The terms are a big mitigating factor because you're not going to get fees. So where are they going to get paid? They're going to get paid on carried interest. So it raises the bar when they underwrite and they put an opportunity in the select opportunities, because they're not getting paid just to put invested capital into another company. They're getting paid on the upside after the investment and when they realize the company. And that's why we really like this investment. It improves alignment with investors, stronger than a fund that does have a management fee.
So is it appropriate for me?
Yeah, please, Brian, yeah.
Yeah, Tim, I wouldn't invest because the fee is, there's no fee. That's basically.
That doesn't bother me.
Yeah, no, but
I like that.
the
We
fundamentals,
do that more.
the fundamentals of these companies, so that when we've done, I mentioned that those companies since that recap have grown earnings at 33%. And we've already had realizations that are 2.5 times, 3.9 times, and not 5 years, in 2 years, 3 years. So these companies are just what we thought they were, and this is really the fundamental inception of the idea, or the reason for the idea is these companies continue to perform. Yet we've sold off a piece to someone else, and they're adding value also, but we feel like we'll continue to drive value. So there's frankly a little bit of jealousy. We were saying, wait a minute, you know, someone else is benefiting from our origination and our portfolio company, if you will. But we don't want to give up this idea of really disciplined liquidity, particularly in this market where prices are very high for growth companies and for some of these sectors that we describe. 20 times operating income.
Well, I look forward to you proving me wrong.
You know, that's one of the
You do
things.
extremely well.
That's one of the things that that motivates us. We hate losing, we love winning. So it's a good question.
Anybody else have a question or concern? I'm glad that you voiced your concerns, Tim, so we understand whether you're voting or not. Anybody else? All right, all in favor? Aye. And in opposition? There are 2 in opposition. Okay, thank you very much.
Thank you.
Carlisle. Let's see. Okay, 1 pops, thank you.
Ryan, you want to come out? We assign for.
Did you know if I have to say something? Did you make a sign?
All right, Paul.
All right, good morning. I'm going to be very brief here. First of all, we're not doing nothing but energy. It just turns out that we had 2 great opportunities come in front of us, and they happen to hit at the same time. And they are complementary strategies because we're going to do the first one, which is an international energy strategy, and that is the Carlisle Fund, and then we're going to go over to Aries, which is a domestic strategy. Both have a element of upstream, but also midstream, and in some cases, downstream energy. These have all been, in this case, for our energy investments, we usually have Mercer do the underwriting of the investment. Staff gets involved in doing due diligence as well. We've met extensively with both teams and felt very positive about their ability to deliver on their strategies. As Linda's pointed out, these are consistent with our investment strategy, which was laid out in May of 2018 and approved. And it's all compliant with our existing investment policies. So with that, I think I'll just turn it over to Bob McGuire, and you can tell us about your.
Thank you. Thank you, Chairman. First, as a partner in Carlisle, generally, I just wanted to express our appreciation to the council for your support generally of Carlisle's real asset business. But then as a partner in our international energy fund, I wanted to spend a few minutes not going over ground that you've already seen because you have the materials, but just hitting what I think are the highlights of the strategy because it is unique in the market. It is a fund that is focused on conventional energy, oil and gas, upstream, downstream, and midstream, outside North America. Now, the reason why that's important is because when we looked at it, 85% of the private equity capital that goes into energy inside North America. And I have been in this business outside North America. I'm American, but my whole career has been in London, 35 years in London. And to me and to my partners who have 40 years of experience also outside North America, the rest of the world is a very big place. The IEA will tell you that between now and 2040, even in the energy transition, expected capital investment for upstream oil and gas is something like $21 trillion, of which 75% will go outside North America. So this is a huge opportunity set as we see it. And because we are forced outside North America, we are the only fund where you can force exposure to that opportunity set. So as a differentiator in an energy strategy, force exposure outside North America, we're the only way to achieve that. Now, the question you ask is, well, why do we want differentiation outside North America? And that's an important point. And let me just spend the next few minutes describing what I think are the significant aspects of that. I won't draw comparisons to North America specifically because I don't know enough about it and I don't want to speak to it, but I'll say what I think are the highlights for us. I mean, some very neutral points. I mean, it struck me, I've never thought of this before, but you began this meeting by quoting the WTI price of $53 today. We think in terms of Brent. The Brent price is $60. That's a big difference. There's lots of reasons why that is, but that's the environment in which we operate. Our break-even price in our portfolio per barrel on a cash basis is under $10, and on a full cycle basis is under $20, which means that the commodity in our strategy is actually a relatively, it's in the background in a sense. It doesn't drive the value enhancement, it doesn't drive the value creation for us. As we look back at Fund 1, our first fund, the change in commodity price only explains between 10 and 15% in the change in value. The way we see the commodity is it's an underpinning of value. It's not a driver of value. It's the real asset behind the strategy, which in effect limits the downside. The way we enhance value is through very traditional buyout tools, efficiency gains, cost takeouts, we increase production, we add reserves, we do bolt-on M&A, we optimize capital structures. This is not, by the way, a leverage strategy. It can't be because leverage isn't as available outside North America as it is here. But it's traditional buyout tools that we apply to mature businesses that are producing oil and gas today. In other words, generating cash. And that's another important feature of our portfolio. It's very cash generative. In one case, we returned 100% of the equity, $600 million of equity in the first 11 months. In one of our bigger investments, we paid a 20% dividend in the first year of ownership. We pay a 20% dividend in the second year of ownership, and that includes a $450 million acquisition in the first year and a $300 million acquisition this year. These are big global businesses that are generating cash today on oil prices, which in the context of the business are marginal, or way intramarginal, what I mean to say. In other words, well below the current oil price. And as a result, we are able to look for and target a 25% net IRR in our portfolio. Now, there's lots of reasons why this opportunity set is available to us. If you want to think about the types of things we're looking at, it's portfolios that have been previously owned by major oil companies who, for various business reasons, in the ongoing management of their portfolios, they decided to sell. So one of the bigger ones we bought was from Engie, the French state-owned gas utility. And we were able to buy that business that had $2.1 billion of EBITDA in the first year for $3.5 billion of enterprise value. So well under 2 times EBITDA, which is why we are relatively confident in targeting 25% net IRR, because we're coming in at a very, very low entry price. But having said that, and the rest of the world is a big place, I think it's also important to make some ESG points. Because one of the things people worry about, particularly from the vantage point of the US, is what is actually going on in the rest of the world. Isn't it dangerous? It's different, but it's not necessarily dangerous. And let me make the point here that of our portfolio, 80% is in OECD countries, developed economies. So Norway, UK, Holland, Germany, Switzerland, Spain, France, Italy. These are very advanced economies, advanced countries from the governance point of view and social expectation point of view. But environmentally, again, I think it's worth making a distinction between what happens here where ESG is a concern and should be a concern. But if you think about where we're operating, our biggest installation is in Norway. Norway is in many ways ground zero for environmental concerns, particularly in production of hydrocarbons. And it's reflected in our portfolio there. So our largest installation, which is a big gas producer, which would normally power offshore from gas produced on the platform. Because we're in Norway, we bring hydropower, renewable hydropower from shore through a 100-kilometer cable to power that installation. So in effect, we're producing hydrocarbons, but we're producing hydrocarbons with zero emissions. In another field, we have Q13A, also in Norway. We have a very advanced, I think it is experimental, I will admit that. It's an electrolyzer, which is converting seawater and extracting hydrogen and powering the platform with hydrogen. In our big LNG facility in the far north of Norway, we're the only, well, there's one other, there's only 2 assets in Norway where you are producing and re-injecting CO2. So it costs a lot, but we're re-injecting CO2 into that reservoir, which is an important tool for managing, ESG, greenhouse gas emissions. And we're emphasizing natural gas. Now, natural gas there's a lot of controversy around natural gas, but if you look, for instance, in the UK today, the greenhouse gas emissions in the UK today are at their lowest level since 1880. And the reason for that is because the UK has come off of coal and replaced coal-fired power with gas-fired power. And that's a very important point, because that's, when you look at the future of where this business is going to go, you talk about, is this a declining industry? I mentioned already $21 trillion that the EIA thinks are going to have to spend. That includes natural gas, which will be growing as a part of the overall energy portfolio in the future for the world. And it should, because in terms of being able to meet target climate change targets, natural gas is going to be a very, very important tool to do it. So, as I said, I don't want to draw direct comparisons to U.S. opportunities, but I do want to make the point that if you want exposure to this type of investment outside North America, we're the only one that can do that or can force that exposure. Others will, there can be global funds, but almost as I always say, 15% of those funds will go outside, 85% of those funds will come into North America. So that's the big differentiator for us. That's what's driving us. They said the 25% net IRR target for Fund 2, 2.5 times money multiple, but with an ongoing distribution of cash and dividends throughout the whole period. So in our first fund, we will distribute 0.5 DPI already by the end of this year. And as I say, we have several companies that are generating, in one case, 50% dividend yield this year, 20% in another, and so on. So a lot of cash generation, and we in non-scary companies.
Thank you. And then, of course, we have Amy and Richard here from Mercer, if there's questions that you want to address.
So explain the co-investment piece, so we understand that.
The co-investment piece is viewed by our LPs as a prize benefit for our fund. And if you look at in the experience of Fund 1, I'm not sure where the yeah, it's in there. If everybody had taken their pro rata share of the co-invest, we would have had a 37% gross IRR. Now, it's important to know when co-investors come in with us, they are behind us and in effect passive to us. So when we go in, they go in. When we go out, they go out. They are in effect just following the flow. So there's no possibility of being stranded or sent, on an independent trajectory because you're behind.
But you choose the particular investments that will be.
We choose, but if you look at the fund, and it's an interesting factoid about the fund, that it was, our first fund was $2.5 billion. But in that $2.5 billion fund, there's a portfolio now containing $8 billion of equity. Meaning we were able to go to our co-investors, give them as much co-invest as they could possibly consume, which was about $1 billion. But then we still had to go out to raise $4 billion plus from partners. And the partners were CIC, the Chinese Sovereign Wealth Fund, CVC, European Private Equity Fund, Vitol, the largest oil trader in the world. And the reason we did that, we were reaching deliberately for the larger transactions because we believe in this business, it's safer to be big than small. It creates more optionality, gives you more levers to react to macro changes or macro developments. So you can accelerate this CapEx here, decelerate that CapEx there, depending on what's happening in the world around you. And you have more ways to create value. So that was why, and it also creates less competition. So one of the reasons why we were able to buy the energy portfolio for less than 2 times EBITDA was partly because we were able to scale ourselves beyond the capacity of most other competitors because we joined up with CIC and CDC. And that's an important part of the strategy. But I think as that statistic of the 37% IRR will tell you, that is because the co-investment opportunities tend to be in better investments in the fund, probably because of the larger investments in the fund.
So, Paul, Vince, mechanically, how does that work? So Bob brings us they're going in and they're suggesting that we would have an opportunity to co-invest. We decide whether or not we want to participate.
We don't retain any discretion. The discretion is delegated to the GP.
Oh.
Now, there may be some transactions, not here, but we actually have one in the hopper where it is potentially a one-off, not in the energy space, but in the transportation space, where it could be a one-off co-investment. But there again, we're dealing with a name brand general partner that can share materials with us, and together with our consultant, we can decide whether that's something we want.
But in this case, we are committed to the co-investment. If you choose to put that into that portfolio, you get our pro rata share.
But it would be on a pro rata basis, which I do not, we would not sort of individually.
No.
Just curious, would you talk a little bit about, you said your break even was under $10 and under $20. Could you explain that a little bit, please?
It means that when we bought, for instance, from Engie, a French state-owned gas utility, which was trying to go upstream to operate and manage an upstream business, you don't want to put too much of a fine point on it, but they're not that efficient as an operator. And it's pretty easy to take costs out from something like that. That's a little bit unfair possibly to Engie, but I think in that case it was true. Another one we did was buying from Shell. Now Shell is a more typical operator because that's where you will take a large company who is operating an asset, has been operating an asset for some time, developed it into a mature business, but because of the way Shell operates, it has to operate. It's not irrational. As a shareholder in Shell, what you want Shell doing is concentrating on delivering big new projects. You don't want Shell worrying too much about the project it brought on 20 years ago that it's now managing the tail of, because the big value creation was when it first brought it on. It's really just about cash management for Shell at this stage. It's an annuity. And so the result is Shell and the organization of Shell tends not to pay much attention to that. And the result is Shell does not commit capital to that because other projects are competing for capital. So if you invest in something, you can bring the costs down because you can create, put more fluid that can produce more volumes that can, on a per barrel basis, justify the investment and justify the cost takeout. So it's a lot of different ways, but it's basically playing off of relatively inefficient operators as the prior owners. And in case that sounds too much like a fluke, you need to understand that in the U.S. industry that used to be called an exploitation strategy. Apache made its name buying businesses from companies like Amoco. I sold Amoco's business onshore in the U.S. to Apache in 1991. That made modern Apache, and it was all about just running the business more efficiently. That's what we're doing.
All right. Yes, please.
Just one question, what are the sovereign risks?
Sovereign risk, well, pick your country. I mean, they're different. Norway is they have changed the tax regime from time to time. Not as bad as the UK. We find actually the more stable country in Egypt has been operating a production sharing contract system since 1954. and they've really never missed a day. They've never missed a day. Well, even through the Arab Spring, they were supplying the oil industry because it's such an important part of the economy. They've been providing diesel to the supply of the oil industry throughout the Arab Spring to keep it going. They tend not to change those contracts in those kinds of regimes. I would say the bigger risk is someone like the UK, where you can have Brexit. You can have Scotland breaking off from the UK. Those are much bigger. As Dick Cheney said, the biggest political risk that US companies faced was the US government imposing sanctions on countries they were operating in. Countries themselves tend to be, because it's such an important part of their economy, relatively stable from the energy industry point of view. And where they're not, it's pretty clear that they're not, so we stay away.
If I could, I'm sorry, just go back for a second. Does that mean, do these break-even numbers mean that if the price of oil stays above those numbers, that you have a pretty good possibility you'll remain profitable? Is
So
that
on a cash basis, we're being profitable at $10, less than $10 a barrel. On a capital return basis, we'll remain profitable at 20.
pretty good deal? I like that.
Go ahead, those numbers.
We may be going there, who knows?
Anybody else? Please.
Based on the recommendations of the Council Investment Committee, Private Equity Advisor Mercer, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment up to $105 million to Carlyle International Energy Partners II, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second.
Mr. Chairman, you were too quick to make the motion. This is more a question for Richard or Amy, and it has to do with your fund terms.
Your what terms, I'm sorry?
The fund terms,
Fund terms.
and that's on your page 240, your page 15, not page 243. And the one that really made me read it more than once was the fact that it wasn't, it was inconsistent with ILPA. Can you just kind of, and the other one that I had to actually underline was the first one, because I don't understand the step down, as you call it, the difference between the net invested versus the committed. But as I just go down through it, maybe it was just a bad day for me, but I really thought, why did you put all this stuff in here? You could go through it.
Yeah, terms are confusing.
And especially the ILPA problems, the inconsistency with that.
Yeah.
And, I mean, why aren't we just doing this make or break type of thing? You know, that we score, they score, instead of all of these other little things in here, protecting Carlisle if they don't score.
Yeah, fund terms are unique from fund to fund, and we try to look at it from a holistic standpoint and to ensure that there's strong alignment between managers and the partners. ILPA Principles is a document that first came out in 2009 and was revised in 2011 of what they felt the best practices should be that limited partners should encourage managers to pursue. And on the distribution waterfall, where you see that it is inconsistent, they recommended that an all contributions plus preferred return first structure be the best practice. But they also acknowledge that a lot of funds don't follow that all contributions first yet. And so they recommended a modified deal by deal, which includes the return of all fees and expenses and not just allocable fees and expenses. But they do recommend the best practices, all contributions, and so we do point that out in our analysis. On the management fee, what the step down is usually during the investment period, there's a higher management fee because there's more work being done sourcing investments and doing the due diligence, getting into the investments. Once the investment period is over, the management fee steps down to a lower level to reflect that they're not doing as much work. And so the step that, and actually ILPA Principles recommend that there be a step down in management fees. There's actually some funds that don't have a step down. It's fewer now than 15 years ago, but there are some funds that actually don't have a step down after the investment period. And so you can see that rather than being based on commitments, which is kind of the highest number on the base, it steps down to net invested capital, which is whatever the remaining investments are to reflect the work that they're doing on those investments. So if they do a realization, that base goes down.
Keep going, go to the investment term, because I thought 6 years was slow, so just kind of go right through it. And,
The investment term?
just the transaction fee, because that's, you know,
Yeah, so transaction fees,
violates the deadline.
so 100% credit is actually consistent with what OPA principles recommend as well. So when they do these deals, there may be some, back 10, 15 years ago, it was common for these deals to have monitoring fees where the companies would pay the private equity firms monitoring fees for consulting services that they're doing to help with the value add that you heard about as part of the strategy. Well, it created kind of a misalignment when it's not 100% offset, because that's now value creation going to the manager as opposed to benefiting the limited partners. So we want to see 100% there because it really removes that conflict from the manager putting on all of these monitoring fees, director's fees, et cetera, and having that value go to them rather than go to the limited partners. So that's actually a term that is consistent with OPA principles. Clawback. So what a clawback refers to, when you have a deal by deal distribution waterfall, they take carry they can take carried interest before they've returned all of your invested capital, potentially, if they have a good performing investment. But what happens is, and this happened actually in the late 90s to a lot of venture capital funds, they have good investment, and then the tech crisis happened, the rest of their funds tanked, that carried interest was no longer working out from a calculation standpoint, so they needed to give it back through a clawback. Well, usually clawback terms are at the end of a fund life, and what OPA principles has said is, we recommend an interim clawback assessment so that there is some type of assessment before, you don't wait to the end of the fund period to get to go after that clawback, basically. So this fund has it at the final distribution date.
Thank you, Mr. Chairman.
Sure. Any other questions on the board? All right, are we ready to vote? All in favor? Aye. Any opposed? One in opposition? Thank you very much. Carries.
Okay, I'm going to introduce Vera Cooper and Nate Bolton from Series. Again, this is kind of a unique opportunity that came up. This is a $1.5 billion fund cap. Looks like it would be like a $1 billion or $1.1 billion fund, something in that range. And what attracted us to this is that the portfolio is already partially specified. In fact, depending on what the eventual fundraise ends up being, it's already 60% committed. So that meant that Mercer and staff could actually underwrite the existing portfolio, which was very helpful. We got a sense that there's good upside here that we should be able to realize in the near future. The other interesting thing about it is we get the capital deployed. So unlike most closed-end funds we go into, where we wait for the funds to get deployed, now we're going to go in, we'll get an immediate capital call as soon as we're closed. So those are two defining things here. But again, everything's been written by the consultant. It's compliant with our approved investment strategy, and it's consistent with our pacing audit. So, Nate, you want to introduce the council? Oh, I'm sorry, Eric.
I've been here a lot. I was here just Friday, just also catching up with Dave and Chris. So I'm Mary Hooper with Aries Management. This is another management committee at Aries. I've been there for over 25 years and partner in PE. And as you all know, because I've been here a lot, over 20 years, really, we are blessed to have you all here in Mexico SIC as one of our very top core partners, period, in this story. I don't think I traveled to any other states more than I traveled here, and that speaks volumes to your staff, to the board, and everybody else. And so we really had a great long-term relationship, and we're glad to be able to at least be out here in front of you to be able to talk about the energy fund that we have in front of you. So thank you so much.
Great. So I'm Nate Walton. I'm the co-head of our private equity business, and I'm the portfolio manager on the energy fund. I've been here 13 years. So I've been primarily in the private equity business. Beginning part of my career, I focused on a number of industries. And about 7 years ago, I took over the responsibility of investing in energy. And at the time, we were looking at energy and we were saying to ourselves, why would we want to invest in this sector? It's very capital intensive, it's very volatile. It's not consistent with the way we like to invest, which is downside protection. How do we get low loss ratios? And what we saw though was really an opportunity to, I heard Bob's comments about 85% of private equity energy investing in North America. We saw an opportunity to do it in a different manner. And that different manner was to really focus on scale. I agree with Bob's points that the energy sector scale matters. It lowers your risk of loss. But it also required flexibility, because what we've seen in the energy industry in the past 5 years, since November of 2014, it's really the most volatile period in the last 30 years. And there's reasons for that. I'll walk into the reasons for that. But we have what we call a flexible capital investment approach. What does that mean? It means we are able to pivot the strategy based on the opportunity sets in front of us. And if you sit here and say, we're going to do the same thing in energy that we've been doing for the last 20 years, you're going to have disappointing results, because the market has changed fundamentally in the world. And we'll talk a little about what has changed in the world, but it's been that ability to pivot our strategy and react to what the market is doing. So has allowed us to find what we would argue are some of the most interesting risk-adjusted investment opportunities, not just in energy, but in private equity as an entire asset class, and infrastructure as an asset class. And so, just to take a step back, why did this opportunity set get created? If you go back 10 years ago, the U.S. was producing 5 million barrels a day of oil. It was in secular decline. Then you had the advent of the U.S. shale, and that's started in other parts of the country, and eventually has come here to New Mexico and West Texas in the form of the Permian Basin. But fast forward 10 years later, the U.S. is now producing just over 12 million barrels a day of oil. So it has literally doubled, more than doubled in a 10-year period. That has made the largest oil producer in the world. And that kind of fundamental change does not happen to an industry that is growing at 1%, because energy as a long-term demand grows at about 1% more. It's been happening for about 50 years. And it's really driven by population growth more than anything. There's some movement around economic activity, but really population growth drives energy demand. So when you add 7 million barrels a day of oil production to the world's oil supply in a 10-year period, what happens? Prices collapse. And that price collapse has caused ripple effects throughout this industry. It's caused ripple effects throughout the world. It's changed balance power, frankly, between how the United States deals with its energy policy abroad. It's changed regional powers. There's been a huge renaissance of oil production here in New Mexico, as well as in West Texas. To give you a sense of that 12 million barrels today, 4.7 million barrels comes from what is called the Permian Basin, which is a combination of West Texas and New Mexico. That is expected to grow to 7 to 8 million barrels. So there's another 3 to 4 million barrels a day of growth that are expected to come from the Permian Basin in the next 5 to 10 years. That is why ExxonMobil, British Petroleum, Shell, Chevron, Occidental have all made multi-billion dollar investments in this region in the last 5 years. They have said this is the future of the energy business for at least the next 10 years. And what we saw in that opportunity was, how do we invest and somewhat take advantage of this macro trend that is happening? And for us, the opportunity was really in pipeline infrastructure, because what you saw happen is that this area, which historically had 2 or 3 million barrels a day of oil production, now had 5, going to 8, needed pipelines and networks of pipelines effectively to take that product to the global oil markets, to the global export markets. Because the U.S. had a long time been an importer of oil. In 2006, the federal government changed a lot about the export of oil. And so now you've effectively reversed the flows of where the U.S. is sending a lot of its products. And because of that, you need new pipeline infrastructure. So the largest investment in our fund is a pipeline complex called the Epic Pipelines. And those are about $4.5 billion of new construction costs. They originate in New Mexico. They bring the oil production from New Mexico and West Texas down to Corpus Christi, where it then gets put on very large tankers and gets sent around the world. And what that's done is effectively, and we have this in the book, it's taken WTI price, which is the headline price of $53. And a year ago or 2 years ago, before these pipelines were put in place, those companies in New Mexico and Texas were selling at actually WTI less $20. So they were selling at $33. Our pipeline just started up a few months ago. That has now gone down to about a $2 discount. The reason that's a $2 discount and now they sell for $51 is because we charge $1.35 to move the oil 800 miles in a pipeline to Corpus Christi. That means those companies can now receive the Brent oil price that Bob is referring to, because when they're on the market in the global economy, they can actually charge the Brent oil price. Those types of fundamental shifts do not happen very often in an industry like that. And so we saw this as an opportunity to invest. Now, one of the questions we get asked a lot is how did you generate 27% gross IRR on over $4 billion in the last 5 years when so many other energy managers underperform in that sector? And the reality is because we were not wed to a certain strategy. We are not sitting here drilling a lot of oil wells. We're not an upstream investor. We really are saying, where are the gaps in the market? In this instance, in the last few years, the gap was building new pipeline infrastructure. And Paul and I have had a lot of conversations around what does that mean for the broader MLP space? And I think we've come to realize that the MLP space is the aggregate of the U.S. energy industry. And a lot of the other places outside of West Texas and New Mexico are actually now flat or declining. And so if you want to have exposure to the growth of the U.S. oil industry, you need to have exposure to the Permian Basin, which is effectively 80% of the expected growth over the next 5 to 10 years. You cannot buy that exposure directly in public equity security because those companies are aggregations of all of the U.S. energy industry over the last 10 or 20 years. Which is why we like our assets specifically, because they're very tailored and focused to the region that is growing fastest, and therefore we think has the most downside resilience. The other thing I would say we do a lot of is we try to use structured capital. So when we think about structured capital, what that means is oftentimes we will use some level of preferred equity or debt securities in addition to common equity so that we can change the risk profile of our investment. And that allows us to have some more seniority in our investment alongside common equity. And that combination we also think gives us downside protection in what is clearly a volatile industry. And if we can use structured capital, we can use midstream investments, midstream infrastructures, and generate a 20 to 25% rate of return as investors. And again, I co-head our private equity business. We look at that and we compare that to the PA guys do a great job. Paying 20 times EBITDA to generate a 20% rate of return is also a risky business. And so we look at risk across different asset classes, across different geographies, different opportunity sets, and we say for our capital and our investment dollars as a firm, we like what we're able to do in effectively the energy infrastructure economy in this market at this time. And to Paul's point, lastly, the fund is $1 billion fund. We have already invested about $800 million of it. So we have invested the vast majority of it, and fund pipelines that basically been built over the last 18 months. Some of them are already operational and flowing product today. And so you're actually getting a benefit now. We actually think you'll be the last investor to the fund. Some other investors came about a year ago. So I think there's a benefit coming in.
Yes, so our fund size was targeted $1 billion, and we're pleased that we hit that target. And we'll be holding our final close here this next month. Again, we'll probably end up in 1.15 and 1.2, maybe a little more. But again, we really appreciate the time, and if you have any questions, we'd be happy to answer.
Yes.
I have 2 questions you can answer, whoever would run it. Let's do first. The first is that this is where we're using the MLP proceeds to partially fund it. So we had promised the commissioner that we would address our outlook on MLPs and why we're selling and so forth. And the other is, I know that you have some actual ownership in some New Mexico properties, if you would discuss that.
Well, why don't you talk about, give a little more detailed update on the EPIC pipeline, when the gas liquids goes on and when you convert the other pipeline back to oil.
Sure. Well, why don't we start on page 54, which is just,
What's the title?
this is Salt Creek's New Mexico asset. So this is our regional midstream company. And this addresses some of the activity we've done here in New Mexico. But this is, you can see these lines on page 54. This is about a $2.5 billion regional build out. And about $500 million of that capital is just being spent in Eddy County. So about 20% of this system is being built in New Mexico. You can see here, the estimate is that we should pay about $5 million.
That's page 390 in the village.
I'm sorry. Yeah, it's 90.
Thanks, Chairman.
So this was, as I was mentioning, this is the regional system that we're building here. And this hooks up to each individual well, and then it transports these products from this map, which is about 7 counties in New Mexico and Texas. The bottom part of this map is really the regional center. And if I go to the next page, page 55, which is the EPIC project. This is
418 and 419.
Thank you. So if people are on that page, you can see here the EPIC pipeline project, which connects again to that regional center, then goes about 800 miles through West Texas and it works. And Paul's point, if you look at the very next page, hopefully it's the next page, number 56. This is what happened when this pipeline started to flow oil. It was 2 months ago. So this is the price, the differential that producers in New Mexico and Texas received was $20 because there was not enough pipeline capacity. They were literally trucking it on roads out of West Texas and New Mexico. It's frankly very unsafe to have those number of trucks on the road. So pipelines are actually in many ways a more environmentally safe decision to get trucks off the road. Second, this allowed producers in West Texas to get a better price to themselves because before they were selling at $20 less WTI. So now they're selling at $2 less WTI. What should that mean? It should be more drilling activity in New Mexico and West Texas by these both small and large companies who are getting better profits than they were prior to the pipeline coming online. The last thing I'd say on the pipeline, just again, to echo some of Bob's comments about ESG, we take ESG incredibly seriously. Our firm is taking a lot of diligence to monitor every one of our companies, not just in energy, but in energy. An example of that is on the EPIC pipeline, we laid a $75 million fiber optic line side by side with the pipelines. And that was an option that is not required by FERC or any government regulation. The reason we did that was because we wanted to have state-of-the-art fiber detection for leak systems. Because generally pipelines, the way they do leak detection is they check from each meter to the next meter, and if they're not the same as in the first meter or the second meter, they think, oh, I must have a leak, and they go back and they look. That is a 30-year-old technology. What we decided was if we laid fiber optic sensors along the entire pipeline, we would pick up instantaneously any kind of leak detection. We hope that there will be a leak.
That continuous sensing?
Correct. It's a $75 million investment, $4.5 billion project. We thought that was the best in class, and we think over time, potentially the U.S. government will force all pipelines to have fiber leak detection. So those are the kinds of proactive steps we're taking in our companies.
Treasurer Eichenberg, does that address your earlier question about MLPs and the space? I mean, it's very much of a capital-starved business right now. The MLPs can't access capital in public markets. There's fewer places for energy funds to go in the private markets. So it's creating an opportunity that we can solve a problem like has existed here in New Mexico for some time in terms of getting our oil and gas out of the state.
So Paul, there's usually a lockup on MLPs, so we're not able to transact immediately. Are we able to get rid of our existing MLP portfolio?
First of all, we're not getting rid of our existing MLP portfolio. We are going to sell down, strategically, because prices go like this, we can be smart about when we actually sell. But the notion is that we would sell that down to fund as capital is drawn down in the Ares fund.
Mr. Chair. So what's the timeline on that, and is this the only way to pay for this investment? Or is this just sort of the thinking that one could replace the other?
This is not, I mean, we have $200 million plus a year to dedicate to all of our real asset strategies. We just approved Carlisle at 105, this one's gonna be 100, so that really takes up most of it. And just trying to manage generally because we have a lot of other spaces that we can invest in the real asset world. We're anxious to increase our infrastructure exposure, we're looking at a transportation deal. Right now, we're looking at a European infrastructure deal that really has different characteristics than most US infrastructure. So it's just trying to manage the size of our overall exposure to the sector we're in.
And so what's the timeline on drawing down the MLP?
Well, I think we'll get a capital call probably, it'll take 45 days to document, and then we'll get a capital call shortly after that. And it sounds like we're gonna get a capital call for 80% of our
Yes, Michael.
I wanted to ask you, sir, what determines the price to access the pipeline? And what determines priorities to get to the pipeline? How does that work?
Fascinating question. The price is set by FERC, so you have to take your tariff rate and you have to go to FERC and you have to get it approved. Because these are large scale infrastructure assets, they have to have a published price at which shippers are able to access them. However, the space goes to those shippers who make the longest commitments or the biggest commitments. So what happens, very large companies, Shell, Exxon, Noble, others will come and say, we will make a commitment and we will pay you for 10 years, no matter whether we use the space or not. Because they want to protect and ensure that they have capacity. Now, for the smaller companies, the way they protect themselves is the trading firms, which are Vitol, I think Bob mentioned, and other firms, will take it out and that's their business. They will effectively buy the space on the pipeline for 5 or 10 years, and then they will sell that space to the smaller companies that are effectively marketing business. That is why these are such great assets to own, because it almost is irrelevant the price of the oil. These companies have now signed up for 5 to 10 year contracts to take all of the space of the pipeline, regardless as to whether or not they drill or not, because they had to reserve the space, otherwise they would have a risk.
What about, how does it work if you want to change the price? What is the process with FERC? Is that possible?
It's possible, but very complicated. So it's unlikely if you change the price until the contracts roll off, which are 5 to 10 years. You can't really change the price until your contracts roll off.
We would agree to that, but then you have the opportunity to go back.
Upward. That's it. And at that point, 5 to 10 years from now, you've generally taken all of your money and a minimum rate of return on the pipeline. And so you have some flexibility around that.
And I'm not sure who could answer this question, but it seems like previously we have discussed the New Mexico situation, that whatever West Texas is, we can't budget that as what we're getting because of the haircut we take because of the transportation issue.
Right.
And is this going to help alleviate some of that?
Kindness. That the market for the next 5 years is showing that there's a $2 differential in the market price.
Yeah, that's substantially less than what we were.
Than the $20 that was the prior.
Mr. Chairman, I had a question about the percentage of volume that we're talking about, and Don, our economist from LSE, is here as well, but so it sounds like that would be the case, that it would impact the revenue estimates on the price side, but what percentage of volume are we talking about with respect to how we currently estimate revenues in the state? So that would be my main question. Would this impact majority of the volume that we're estimating currently with respect to that price differential on what we see on the tax basis?
Yes.
So we have considered the EPIC pipeline, along with other pipelines that are currently in the works in considering our price differential. So we've assumed that it would go back to historical averages, which is between $2 to $4. which is different than the $20 or so that was seen before. So Epic pipeline was included in that, but it's not the only pipeline that covers our volumes. But that's on the oil side, and we have other considerations on natural gas pipeline issues that could potentially constrain oil production and natural gas production in the state, which would affect the revenue estimate in a separate way.
Okay, yes,
So
Michael.
one further question, is part of the agenda to sell these assets at some point, or just to operate them, or is that subject to your opportunities as you see them?
It's actually, it's something we wrestle with a lot because, as I mentioned, we think these are generational assets. Pipelines like this get built in a rapid growth period, which happens, in this case, every 20, 30 years. As you experience here in New Mexico, it's not the norm to have this much of a need for new supply of pipelines. So our view is we'd like to hold them because at some point they compound a very high rate of cash on cash. 4 or 5 years out from now, they could be returning 20% cash on cash return, which we'd like to hold and harvest. But at some point, the fund life is expected to be 10 years, and so that's probably in that 5 to 10 year period is historically what we thought about harvesting.
Tim, yes.
Most of the time we're talking about, what do you do for natural gas? So you run the same pipelines or?
Yeah, so we move natural in a regional center. The Salt Creek Company does gas and crude, and it takes it to the hub in West Texas called Waha, and that's the hub for natural gas. And then there are other companies, either oil and others, who have built gas pipelines. And so we don't have long-haul natural gas pipelines. That's the business. On the long haul, but on the regional, we do gas and crude.
These pipelines, if you go back into the 80s, and some of the pipelines that came, one of the biggest problems we have in Farmington is the gas gets stranded there, or oil can get stranded in Farmington. And everything went to California, and California literally rapes us when it goes across their line. California's not a very good place to do business. So sometimes we do all this green energy and the windmills, all that stuff that goes to California, we probably ought to have some kind of a ugly tax for wind turbines. Because they would do it to us if they had a chance. And you go back in the 80s, we were putting a real huge recession. Because when PG&E put their pipeline down all the way across from Canada down, and they just cut off buying the Mexico gas in a hurry, and it really affected the Mexico if you go back into the 80s, about 84. But these pipelines, and the guy who's in the pipeline the longest, so if you have a pipeline that comes out of Wyoming and stuff and comes down by New Mexico and then goes to California or Arizona, all those pipelines, if they're full if they fill them and they're up in the Rockies, when they come by here, there's no room for our gas. And so then our gas becomes stranded again, and that's one of the big problems we have in farming, is that you can't get rid of the gas that you have in it, and there's not a lot of desire to build a lot of pipelines for $2 gas, $2.50 gas, whatever. It's real cheap.
Thank you, Tim. Yes, Stephanie.
Thank you, Mr. Chairman. So, I'm real excited about these energy investments as opposed to student housing in North Carolina. Like I can actually. This seems relevant, especially since we're talking about a New Mexico pipeline that really is going to impact the state's ability to take advantage of what the revenue is for us from this industry. However, in the investment committee report, it talked about how Aries, part of your strategy is acreage acquisition. And because the state land office is one of those entities that provides that acreage, I have a real issue voting on this particular item, Mr. Chairman, and so I am going to abstain.
Sure.
But I don't want it to seem as though it's that I disagree with the investment.
Great, thank you for explaining this. Appreciate that. Anybody else? Any other comments? Yes.
I probably should abstain as well, because I don't think you should do it, I just have some property.
that benefit directly from this.
Great, okay, thank you. Linda?
Based on the recommendations of.
I'm happy to do it after you make the motion.
Go ahead, Tim.
I just want to put Richard Ramey on the spot with the risks that you have in here, one of which the land commission has pointed out, which is for acreage. But mixed results in the previous adventures. And then are we invested in other, we talk about this, where the fund will have could have a double impact if there's a loss here with other partners, are we part of those other investments? Those are some of the questions. Thanks.
Yeah, so this did start, so you are in Aries, the ACOF Fund 5, which that's where these investments actually started. And then ACOF 5 kind of started to hit its energy limitation, which forward to the start of an energy fund. And so some of those investments were carved out and they are split between these two funds. So you do actually have exposure to these first investments. The additional ones that are to be made are not expected to be in ACOF 5, as I understand it. So you will have some that are single exposure, but you do have the ones that are in here, you do have exposure through the private equity fund.
And I believe the number on that is $27 million of exposure through the private.
And then kind of what the land commissioner pointed out, which is, again, this is the Permian Basin. And we're already subject to the voluntary area. Why are you recommending us to increase our investment, so to speak? I mean, I can see where you're coming from, but why are you actually recommending this kind of U.S. energy when we're already subject to it here, especially the SIC?
Well, from my standpoint, I just think, we are, as Nate said, we're on, New Mexico is fortunate to have a little bit of a Permian Basin filling in here. And I think that creates a really generational opportunity to finance infrastructure in the state, and it benefits the state. But also, this will carry Texas crude too. But, in the energy space, I just think this is the most productive. It's where all the growth is happening. A lot of the other fields, Nate said that some of the other fields across America are declining now, and this is really the future of oil and gas in America by large margin. So we think this is the place to, this is the low cost producer of energy in the U.S., and if we're going to invest in U.S. energy, this should be the place.
And Mr. Chairman, because of the graph on page 54.
See that. I enjoyed that. That was great. Richard, you still didn't talk about the mix.
I can touch on that, yeah. So we did spend a lot of time.
I was really trying to pinpoint Richard. He has certain tells. I'd like to play poker with him.
So we did spend a lot of time with Aries on this point, and that their previous energy investments were led by a different head, and it did also have a kind of a different strategy. They did a lot of non-controlled. They weren't solely focused on core basins, so they did get hit with some, when the prices changed, they were more affected by it, and we like the changes that they have made. Nate taking over in 2013, looking at their track record post that, shift in strategy and shift in leadership amongst the team has been positive. So we got comfortable with, we kind of like where they have gone, and there's been, a long enough track record that we've seen kind of multiple investments made by Nate and his team, and like the trajectory of which they've gone in. And also just looking at, this is a very different opportunity. You already see where 80% of the investments are, and we actually spent a ton of time. We did some reference calls with other energy and midstream managers to see what comps they were using, and then we spent a lot of time on how they're valuing the assets and where they kind of expect it to go, and got really comfortable that, it's a really good opportunity coming in now. The greenfield projects have been built, they're working, you can take the construction risk off the table, but you're getting that greenfield premium. And so it's an interesting opportunity to come into a fund at this stage where we're actually able to see the investment that maintenance team have made and appreciate them, and they look like strong investments.
Okay, other questions? All right.
Tim, are we all clear? All clear?
Am I all clear?
No. We're not jumping in. Based on the recommendation of the Council Investment Committee, Private Equity Advisor Mercer, SIC staff, and General Fiduciary Oversight of RBK, I move that the State Investment Council approve a commitment of up to $100 million to Ares Energy Opportunities Fund LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate.
Second?
Yes, me.
I just got one question.
Yes.
What percentage of the reserves in the Permian Basin do you think are in New Mexico versus Texas? I mean, just what do you
I'm gonna
hear?
give you my best estimate.
Right, I mean,
This number will go to press.
I think,
Say it into the camera.
I think the general consensus has been around 20 to 25%. But it should be encouraging that the trend is increasingly viewed that New Mexico, right on the state border between Mexico and Texas, is actually the sweet spot of the entire play. That is where Exxon bought in, that is where Chevron has recently tried to buy. So New Mexico might, well, it might have 20 to 25% of the total acreage. Some people would say that's some of the very best acreage, so it might actually get developed quicker.
But we're smack drilling into Texas, aren't we?
From the cost of construction, is it more expensive or least expensive on the Texas-New Mexico side?
It's more expensive than Mexico.
More expensive on the Mexico side by what percentage? I'm just.
Probably 10 to 20%.
What is it?
10 to 20%.
Infrastructure.
Talking about the whole, the building out of the pipeline.
Yeah, and just the access to roads and welders and other tradesmen, it's a more remote part of the basin. So.
Yes, Michael.
You're referring to cost of the infrastructure, not production.
The build cost.
Yes.
You know, for anybody who hadn't been down to Carlsbad and seen the man camps and everything else, and Carlsbad and Hobbs and those things, you understand that those people are all coming from Texas. 90%, you know, I mean, almost a lot of the employees are coming from Texas and other places for truck drivers. Yeah, it's a huge, this thing is really huge. And the nice thing about, I think, to me, it looks to me like if you can save that $20 decline, you know, a lot of that stuff is probably going to show back up to the state in the value of income tax. You know, the taxes that are going to pay because they're going to be getting so much more for their oil. So it'll come back. You know, a lot of that comes back too.
Great, thank you. All right, let's call for the vote. Anybody, all in favor? Aye. Anybody, and you're abstaining? Your 2 abstentions and everybody else is in favor. Thank you so much.
Thank you.
Tim?
I wanted to make a comment because I'm hearing 2 important things. That is, the importance of the Permian Basin, the future of oil and gas production is phenomenal. And now we're hearing the development of connected pipelines, probably other pipelines, that the oil companies are saving $18 to $20. Isn't it time for us to reexamine our oil construction?
And not
Maybe make it comparable to Texas. No. I'd much rather get more direct funds into our fund. And maybe it's the time, they're not gonna go anywhere, they might not like it.
That's a legislative question.
Well, maybe we are.
And that's not prearranged.
You got that very well, Mr. Chairman.
Right. Now, we have got to talk about that.
Well, that's right.
For 10 years,
But
that's
that's
the time
right
on this
with
coming.
us. I mean, it's not like we're, that's new for us. Especially with the trouble going on in the economy in general.
I agree.
No, the loyalty that everybody gets, and that say $20 savings is gonna go to everybody too.
That's right.
Goes to the state too. It doesn't just go to the big oil companies, the little oil companies. It goes to all.
Okay, Blackstone, please.
We didn't
Jack?
really just.
Yes, so, good morning. Good morning.
We probably should.
I've got Jack Cope with me from Townsend. And Jack will be able to answer questions if there's anything about clawbacks or construction or anything like that. And then, oh, Seth, you're up here too. And Alex Hill and Anthony Myers from Blackstone. So we're here to talk about Blackstone Real Estate Partners Europe 6. And this is another deal, unlike, not unlike the Aries Fund, where we're just getting in under the wire here. About to close.
Paul was talking. So,
Yeah.
Can we cut the cross check, please? Okay, Paul, go ahead.
So we just got under the wire on the Aries fundraise, so we're pleased with that because the benefit of that is it gives us a tremendous amount of visibility over the portfolio that's already been acquired. And here, similar, we don't have a big portfolio yet, but we have a large fundraise that is about to close, and Alex was able to sneak us in here. So we have a fairly broad relationship with Blackstone, as many of you may know. We are in several of their sort of their global funds. We're an Asia fund with them. If you look at the history of Blackstone real estate funds in general, it's hard to find one that performed under 15% net return to investors, to the LPs. So they've had an amazing track record going back to the 1990s. But I don't want to steal anyone else's thunder here, so let's.
You already did, Paul, you did all the good things, I was gonna make them talk about our returns. Well, thank you everyone for having us. As Paul said, my name is Alex Hill. I run capital raising here in the Americas for all of the real estate products. I also help out a little bit in infrastructure. So if my face is familiar to you, it's because this is becoming a little bit of a habit. I was here in the fall talking to you about Rep 9, which is our global opportunistic real estate fund, which you guys decided to invest in. I'm sitting here today with my partner, Anthony Myers, who is the chairman of our business in Europe, to talk about Rep Europe 6, which is the corollary to the global fund that you invested in. And by that, I mean Rep Global, Rep 9, which you just invested in, invest in every opportunistic real estate deal that Blackstone does on planet Earth. Rep Europe 6 invests side by side in all deals done in Europe. So in all ways, the themes and the philosophies that you approved for Rep 9 you're going to see those in Rep Europe 6 as well. Rep Europe 6 is going to be a €9.5 billion fund. As Paul mentioned, we are just at the tail end of our fundraising period. We've raised almost all of that capital, and we really have, we'll finish it up in the near future and have the visibility how we get to the $9.5 billion. But we were thrilled that we were able to get you guys in, as Paul said, under the wire. So what I thought we would do, unless you would like us to answer questions, is have Anthony, who I said is, I guess I should have said, I've been at Blackstone now for 11 and a half years, and Anthony more than doubles me with 23. He's the chairman of our business in Europe, and the two of us together should be able to answer any questions. But maybe I'll turn it over to Anthony to talk about the markets that we like today, and the themes that we're likely to be investing in. And I should say, you sort of have perfect timing in that we just turned the fund on 2 weeks ago. So every deal we do now in Europe will go into this fund. So, Mr. Myers.
Thank you, Alex, and thank you all. Just before I start again, thank you for your support of our Rep Fund. We're very appreciative of that and excited to have you potentially invest in our Europe 6 fund. I think just by way of background, we've been investing in Europe for 22 years now, and throughout the cycle, we've been able to generate strong performance, as you can see on page 1. And while the business in Europe is geographically distinct from the US and Asia, we're very much an integral part of the overall global business. There's constant communication across the various geographies. As we share best ideas, we review each other's deals. And as you probably are aware, we still have this one centralized investment committee, which is essentially the same process that has been in place since the start of BREP. Just touching on the team in Europe, I think it's fairly important. Today it consists of about 114 professionals, and it represents a very diverse group of over 20 nationalities. And this is extremely helpful when you're operating in Europe, particularly across the continent, when you're dealing with multiple languages, cultural nuances, and regulatory nuances. And having that broad diversity within our team allows us to allocate our resources and both literally and figuratively speak the language when we're doing deals. In addition to our own people, we have more than 2,900 employees within our various portfolio companies, and this covers logistics, office, residential, retail, as well as hospitality. We are one of the largest private owners of real estate in Europe, and through our holdings and our management teams, we get access to enormous amounts of real-time market data. This again is something that is very challenging in Europe, where the markets are typically opaque and it's hard to get reliable information. So having this firsthand within our own companies is very valuable for us, and it helps us in many cases to give us the conviction around the ultimate pricing of assets. And so when you combine the scale of our funds, as Alex referenced, with the experience and the depth of our teams, as well as the access to proprietary information, we believe that this gives us a truly unique competitive advantage, particularly so in the execution of large and complex transactions. And we're able to differentiate ourselves in these large transactions. We've done a number of them, and if you probably are aware, we recently announced an offer to acquire a publicly traded Canadian company that owns a portfolio of office and logistics properties in Germany and the Netherlands. And this is just, again, an example of the types of large and complex transactions that we can execute. Just moving on to the investment environment, and we heard a little bit about this earlier in this room. I think a couple of points worth noting. Clearly, there is political uncertainty and complexity, and this is just part of the backdrop of investing in Europe. And while this generally does weigh on growth, it also can provide us with compelling investment opportunities through this so-called continued volatility and often interrupted flows of capital in the credit and equity markets. And while overall European growth is moderate and generally trails that of the US, what we're seeing is there are select cities that are benefiting from the ongoing urbanization trends, and as a result are growing faster than Europe overall. And these are generally tech or knowledge-driven places like Berlin, Stockholm, Amsterdam. And these are attracting talented young workers that are much in demand in the modern economy, and as a result are achieving outsized growth in population and in turn rising rents. And these are the focused areas that we're going to focus on for BREP Europe 6. A natural consequence of the low overall growth, of course, has been lower interest rates, which we mentioned earlier. And again, we, like others, expect these to stay low at least for the next couple of years in Europe. What's interesting, though, is that while interest rates are historically at low levels, if you look at the German 10-year Bund, it's negative 34, 35 basis points today. There is still a very wide spread between the government bond yields and cap rates. And we believe that further cap rate tightening is certainly possible. The low borrowing costs are also quite helpful to us in terms of setting up attractive cash-on-cash yields in certain circumstances. Finally, from a sort of fundamental standpoint, I would say the banking crisis from 2008 and the resulting regulatory changes have served really to constrain construction lending. And this has meant that supply remains muted, at the same time that take-up has increased in the face of generally steady economic recovery. This has resulted in low vacancy levels that are approaching 5% for office properties across Europe, and even tighter in certain prime markets. So in the context of this macro environment, we've identified and are actively pursuing a number of investment themes. As is typical for us, we try to identify the larger trends and then to try to establish a differentiated view versus everybody else. We then look to build or acquire the best operating platform or team possible, and then go about executing in scale by offering speed and certainty to sellers, which really plays into our strengths. In almost every case, we're focused on a going basis, but also, and particularly so in Europe, we're focused on the value add potential post-acquisition. Where can we create value through refurbishment, re-tenanting and leasing of vacant space or expansions to existing buildings. And finally, of course, when is the optimal time to sell once the asset or business is stabilized? So our strongest investment theme today, and I think Paul mentioned this as well earlier, is really around last mile logistics. And this is driven, of course, by the fundamental growth in e-commerce. As you know, more and more online retailers are offering same-day delivery, and this demand for last mile distribution is growing rapidly, while at the same time, the supply of the product is extremely limited. And in many cases, the highest and best use of the underlying land is not logistics, but residential or higher density mixed use development. So what you're seeing is that on the margin, space is being taken out of service or being removed and developed into some alternative use. And this is resulting in very low vacancy levels and very strong rental growth. So we've been very active in this sector, and we will continue to be so for 2026. Another strong theme for us has been around the urbanization trend that I touched on in major cities or knowledge centers, and this is fueled again by VC investment and the growth in tech or knowledge-oriented jobs. I mentioned earlier cities like Berlin and Stockholm and Amsterdam. These are seeing young and educated college graduates that are moving there for the job opportunities. And in turn, you see large and small companies looking to locate and to take space in these markets. A third theme that we like is the general shortage of rental housing in many key cities across Europe, as people on the margin are shifting from homeownership to rentals. Most of these properties have been starved of capital, and through investment of fresh capital, we're able to refurbish and improve the overall product and ultimately increase the yield on the properties. A more recent theme of ours has been hospitality or resort hotels, in particular driven by the increased global tourism. Much of this has been focused on frontline waterfront hotels in Southern Europe, where the properties again are in need of capital, and we can refurbish and reposition these assets. Lastly, I would say, worth mentioning is the continued distress and dislocation that is still present in the European banking system. And this is primarily the case in Spain, where we've been most active acquiring both multifamily properties as well as portfolios of REOs or non-performing loans from banks or government-controlled entities at steep discounts to replacement costs. That was an extremely quick overview of where we see the opportunities. I'm happy to take questions at this point. Thank you.
Thank you so much. I think we're ready for any questions of the council. Yeah.
I'll keep asking my same question, Mr. Chairman, and I guess, first of all, let me just kind of thank you both for being here, but I noticed that in the synopsis by Townsend, it said that you charge a little bit more because you pay employees. Accurate statement?
Gosh, that sounds nice to be a Blackstone employee. I think we actually have one fewer fee on this product than we have on the global fund. We don't have an acquisition fee on this fund. Otherwise, I'm not really sure how to comment on that.
Did you want to?
Let me, yeah, Jack, and Troy.
Since you wrote the comment.
that was just, no, you never figured that this time, but I'm working on it. In another couple of years, I'll have it. But that was just in the small. Back to your key terms and your Townsend comments about negative. When it comes to the spread with other peers. Can you go into that a little bit?
Sure, I would just tell you that it's been a common theme with virtually every Blackstone fund that comes before you. They have been a top quartile, in most cases, top decile performer in every one of their funds that's been within their respective measures. It has been something that we've spoken to Blackstone about since the beginning of time. And however, there is a trade-off for very strong net performance and a slightly higher fee. And that is the case here. They're slightly higher on a gross to net basis than many of the peers in the market. And that is really the answer that I can give you. It simply is what it is. But recognize that the performance historically has been top decile across all of their funds.
Net of fees.
Net of fees, absolutely.
Have you, in reading all of this combined and looking at certain things, have you and RBK, have you put together give that analysis of what we pay in fees. I mean, just kind of looking at everything, I mean, we talk about it all the time, but each time you know, to me, it's just almost the
Yeah, I can comment
what's the
on
difficulty?
just recently for the June 30 fiscal year, each town provide your staff with fees paid from a asset management fee and that incentive fee breakout for every single investment that we track. We just sent that actually last week.
So Brent, we do a fee analysis too.
Yes, Treasurer Eichenberg, as part of, it's kind of in addition to the external audit, there will be a fee schedule in the back that you can see by asset class, not only the management fees, but the carried interest when that's completed. And Seth is right, we just received that, I think, a couple of days ago, and we're rolling it up into our overall analysis.
We can't negotiate fees, we can kind of opt in or opt out, right? So, but what we are doing, and I think this, being a small now, but it will be important, is these co-investment things that we're doing. We've just approved our third one, Bart has a fourth one in the fixed income space. When that portfolio of co-investment grows, that can really have a big impact on lowering our overall fee.
Okay, other questions? All right, Lee?
Well, I got one for fun.
No, we don't need fun.
I was just gonna ask Mr. Myers, he didn't make the cut as a key person, you know.
That was not.
But he's gonna be on the list next time.
Okay, I hope so. All right, are we?
Based on the recommendations of the Council Investment Committee, Real Estate Advisor Townsend Group, SIC staff, and general fiduciary oversight of RBK, I move that the State Investment Council approve a commitment of up to $75 million to Blackstone Real Estate Partners Europe 6, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Second. Is that second, Harold? Okay, Harold, second, thank you. Any other comments? All in favor? Aye. Any opposed? 100%. Thank you very much so much.
Thank you, we're grateful.
Thank you. Next item on the agenda is our major library sign.
Well, Mr. Chairman, I'll pass this off just very quickly. Turn it over to Mr. Diaz. This is the most recent fund in the door, thanks to action legislature to set it up. Funding is small, but there's talk that perhaps it'll grow in the future. I think probably the thing you should know about this particular asset allocation is the statute that controls this fund, in particular the distributions from this fund, is a little bit complicated. So while you're used to sort of seeing asset classes and projections and different mixes and things like that, I think the trick to this one was the complexity of that statute. So their distributions don't start for a little while, but then the formula for them is rather complex. So that really played a lot into what you're seeing in here. So we thought a lot about, over the long run, we think this probably is a fund that we should have more in growth mode, but here initially we think a little bit more safety to it. So you'll see it looks a lot like the TSR that you did just a few months ago. But with that sort of an overview, let me turn to Matthias for the heavy lifting.
So I just wanted to make sure, Matthias, that you just go over like why the zeros are in those classes. If that's part of your.
Yeah, absolutely. I'll try to be sufficiently comprehensive, but please let me know if I don't touch on things. And thank you, Vince, for the introduction. Maybe just a little bit more color as it reflects to the asset allocation, and that's starting on page 507. This is the newest fund you saw reflected in your performance summary as well. We'll continue to report on it with an initial funding of $1 million. I think originally the target was closer to $50 million with a sustainable $2 million distribution, but certainly was a little bit smaller than that. But it does appear that there is some support in the legislature to provide additional capital potentially as early as next year, and I've heard number 20 million being considered as that, but that's just, I think, an aspiration at this point. There's also talk about potentially some constitutional protections that would also turn this into more of a true permanent fund and have some implications on the long-term asset allocation that would be viable and a sustainable path to that. As Vince mentioned, the distributions won't start till fiscal year 2022, so a little bit of a break there. And it does have a fairly unique distribution formula, somewhat complicated, particularly in the early years. And really what that distribution formula has led to is a greater need for income, more stability, because you don't, much like your other permanent funds that you have, that look back 5 years on the market value in order to determine what a smooth distribution would be. In this case, it's really just focusing on the most recent year, and really it's the way that it's designed is the lower of income or 5%. So with those two components in mind, you really have the potential for essentially zero distributions, no distribution in any given year. And if you have a fairly high octane type of an asset allocation that does focus on appreciation, there is the risk that you may end up with years where you have no distributions. So as part of that, you'll see that we're focusing on an asset allocation that does have lower total return capabilities when you compare it to something like the land grant, but a much higher predictability of the type of income until that spending formula changes. It will change in fiscal year 2028, at least the way it's currently written, at which point it will become more of an endowment model, so that that look back, that 5-year look back that I described. And at that point, we certainly recommend that you review the allocation. So on page 508, these are the capital market assumptions that I think most of you have seen as input to the modeling framework that we use for all asset allocation work. And we review these on an annual basis. So for those that maybe haven't gone through the full process with us, we do provide you those updates and essentially our expectations for the various asset classes in the forward-looking capital market environment. On page 509, this is essentially the efficient frontier across the risk spectrum. So I'll try to provide some detail for those that may have not seen these as often as others. You'll see the portfolios across the top 1 through 10, essentially saying what's the highest amount of return you can achieve for each unit of risk, and it becomes very conservative on 1 all the way to the most aggressive on portfolio 10. There within the green column, that represents the proposed allocation for the Rural Library Fund. And as already mentioned, it's really identical to the tax stabilization reserve due to some of the same uncertainties and needs. I might drop you down to the very bottom line here that says estimated annual yield, and you'll see that that's a healthy 4.5%. So we talked about MLPs, other asset classes, real estate, that really their primary focus is income generation. There are others, but the income is certainly a very attractive component, provides some downside protection. And so when you look at that asset allocation proposed under the Rural Library Fund, you'll see asset classes with high income generating capabilities. You don't see any exposure, and I think this is to the point of the zeros in some of the boxes. No allocation to U.S. equity or international equity. They do have a yield somewhere in the 2 to 3% range, but it's about half of what you could get elsewhere in some of these other asset classes. So you do see a focus more on fixed income and the alternative asset classes, particularly those that are currently designed to generate more income. So I think the only other noteworthy item here, and then I'll stand for questions if you'd like, is that if you look at the expected compound return, and that's that last bolded line, that's the total return that asset allocation is anticipated to return once you factor in the volatility as well. You can see 4.78 and 4.5%. So 95% or so of that total return is generated by income. So most all of it. That's pretty good, and that gives you a lot of reliability in that return. Now you'll notice if you slide over one column to the land grant, LGPF in blue, that's 6.41. So it's a higher total return, but there really only half of the total return is coming from income. So you have a lot more room for the potential for no distributions in a single year, particularly until that spending formula changes in 2028. So when you take that in aggregate, I think is the primary driver why we're putting forward the allocation you see here in green, RLF, 30% to low duration, 22% to the core US Ag fixed income space, 28% to non-core, and the balance about 20% to real estate. Be happy to take any questions or comments.
Okay. So this is very straightforward in terms of the approach we take on all of our funds. Very familiar with this. This is $1 million, so 25 billion. I'm not sure I can measure the percentage, but anyway, it's important to do it right.
So you all have talked a lot about how like the distribution mechanism is sort of complex. Is there a percentage? There's no target.
It's the lesser of 5% for income that's generated.
Income means what?
I think it's the dividends and interest would be my.
Cash income? What is the?
I think so, yeah.
I don't think it includes realized capital gains.
No, yeah, not realized gains.
Oh, really? Or unrealized gains?
Yeah, no.
So more income.
Just natural, what is kicking off, yes. Dividends and interest is how I understand it, but I don't know if it's actually spelled out in my read.
Well, it's dividends income, then usually realized capital gains usually straddles the line, but unrealized capital gains are not including these type of funds. And in this case, we think realized capital gains are on the same side as unrealized, so they're not used for income purposes.
So it's just poor draftsmanship.
It's more complex than we see.
It's not gonna be very much money unless they put more money in. Is that an accurate statement?
Harold, that's the point, is it's very small right now. We've got very expensive markets. We're late in the economic cycle. To put this thing in full growth mode and risk no distributions at this small size is pretty tough to swallow. Now later, if more money comes into the fund and the distribution changes to a more protective mode, then we go to growth and we'll still get the distribution.
Change the number.
Right.
And you have about 52 rural libraries.
52. So 20 or 30 bucks each a year.
I think the only other operative word in this initial spending formula is that it's the lesser, not the greater. A lot of times you see the greater, and I think the lesser is what gives you that potential for no distributions.
It's 2%, it's 2%.
Okay, all right. This is a voting item?
Yes.
Yes, it is, all right. Thank you very much. All right.
Based on the recommendations of the Council Investment Committee, SIC staff, and the General Fiduciary Oversight of RBK, I move that the State Investment Council approve the asset allocation for the Rural Library Fund as discussed, reviewed, and memorialized by the Council today.
Second.
All right. Commentary, questions? All in favor? Aye. Any opposed? Very good. Thank you. That's passed. We're done with that. And Brent, do you have a CFO report?
Sure. No more than 5 minutes. Just a couple of announcements before I get into some prepared comments. The budget hearing we have upcoming is on October 30th at 1:30 p.m. I've got some inquiries on that.
I'm sorry, when?
It's October 30th at 1:30 p.m. in room 322 here at the Roundhouse. If anybody wants to come to that. And then also wanted to I think I included it in my notes on November 21st at 10 a.m. Is our exit conference for our external audit. Our normal audit committee members, of course, will be included on any communication, any drafts, but if anybody else would like to be involved in that process, please let me know. You do have an opportunity to speak with the auditors and get their input on how the audit works and other things.
So does the full council get a presentation or no?
It's just the audit committee and then subsequently is reported to the full council.
Oh.
And then I'm on page 520 of the material. And I just wanted to point out, I know we give this budget schedule out every month. The far right-hand column is the most important thing. This schedule is prepared as of the end of September. You can see as of this point in time, and we're only a quarter into the year, that there's no problems with budget through the fiscal year anticipated. This is the general summary. I think this is more what the legislature looks at. If you go to subsequent pages, you see the account numbers that actually roll up into the 200s, which is payroll, the 300s, which is contractual services, and the 400s, which is the other expenses. And then lastly, I just wanted to tell everybody, I think I handed out to everybody the investment holdings report for the end of September. Because today's meeting was a little bit earlier than normal, we were not able to get this out in the regular materials, but if you get back and have any questions on this, please feel free to reach out to me. I do want to point out that at least for this month, it's a little thicker than normal. And you might say, why is that? Well, it not only has a roll forward of the monthly activity, it has a roll forward of the quarterly activity because we're on the quarter end, and so the report is a little bit thicker as a result of that. And then also, because I've gotten questions on this in the past, I have attached to the last page of the investment holdings report, the fund balance and distribution, which shows the beneficiaries as it relates to the land grant permanent fund and all of their respective ownership percentages that relates to that permanent fund. And that's all I have.
Thank you very much. And we are meeting when?
It is November 21st at 10 o'clock a.m. at our office.
Okay.
And that is a Thursday, so I think it's done to kind of accommodate the auditors because the report is not due until the following Wednesday, which is the Wednesday before Thanksgiving. So it gives the audit committee the opportunity to provide input.
You gave a call in for that.
I might be able to.
Okay.
Maybe Tracy.
And Tracy to the Thursday, right?
Yes.
So it could help you, whatever works best for you. Okay, anything else, any other new or old business? Then Carrie, do you have any?
We do have public comment.
Okay.
Mr. Knoll?
Good morning. Good morning. Kenneth Knoll, investing expert at USI. I was not going to say anything, and then as I heard the presentation, with blood pressure. I've spent some time with my fund managers when I traveled the state. I did find small businesses that we're going to invest in, and I've had to go all over California, to Colorado, to Nashville to become a fund. Very kind of difficult, but that's not what I wanted to really come about. I had the opportunity to go to the Carlsbad Housing Summit, Human Oil Summit. I was invited to present there, and there's a huge problem with housing in Carlsbad, Artesia, Hobbs. And what really frustrates, there's an opportunity zone there, frustrates that we can't find money to build those houses. Part of the other greater frustration is that talking to people who are working in the oil industry, they live in Texas. They come to New Mexico, and they're hired in Texas, so that they pay no New Mexico state tax. And they testified that we could live in New Mexico, we would pay New Mexico state tax. We would live in New Mexico, we would pay property taxes, but there's no investment into that. And it frustrates me when I hear this continuously investing in housing all over the world. It's frustrating to hear them talk about an investment for the last mile in Europe. What about the last mile in New Mexico? And it's really frustrating that this group shields itself on, we can't invest in New Mexico because we have an obligation to, fiduciary obligation to maximize the return. Big monopoly game, you know. I've heard it many times, with due respect, you know, Mr. Moise, I've heard that many times. Maybe not here, but I've heard it when I've asked the question. Second frustration, I was asked to present at the opportunity zones in Las Cruces. The Las Cruces International Airport is looking for an investment to build the infrastructure to hold planes and host people that are coming into the spaceport. They anticipate 128 flights in 3 years where you can have people flying in. There's an opportunity there to service the planes, to gas the planes, to a restaurant to host people. And you know what's happening? I spoke to the Spaceport Commission yesterday. El Paso Airport in El Paso is investing to build those infrastructures. And guess what? So people are gonna fly into El Paso, pay taxes in El Paso, eat in El Paso, stay in El Paso, come to the event at the spaceport and leave. Again, we need to figure out how, you know, when I look around, there's an investment opportunity. You know, it's not a handout, it's an investment opportunity. I see other, you know, Texas has no problem recognizing, El Paso has no problem recognizing that investment opportunity. So I don't know what the mechanism is, but our fund is funding small ramp-up projects. You know, I just think, as one of my business associates, Mr. Herrera, who owns a bus company, said to me, you know, we're missing out on opportunities here because we can't get investments. He said, I'll volunteer buses and take the state investment council around the state. Currently, they don't go around the state because either that or it's not happening. So, you know, like I said, I wasn't going to say anything when I walked in, but when I heard the oil presentation, and they recognized the hardest part about building homes in Carlsbad, because we discussed it, there's no workforce that's willing to work for the pay structure. So there's a lot of, so one of the things that we proposed is maybe we could build the houses in Mexico out of shipping containers and bring them over to Carlsbad. To Carlsbad in that area. But there's, we're missing out on a lot of opportunity in New Mexico while we invest in the last mile in Europe and houses in North Carolina. So,
Thank you very much.
Thank you.
Thank you for joining. Okay, all right, I think we're ready to adjourn.
So
And a second. We are adjourned. Thank you so much. See you
We're next to it.